Meet you. All right. Good morning, Revenue Committee. Happy Friday. Apologies from the co-chair and I for keeping you here until 7 o'clock last night for some riveting discussions. I'm sure you've looked at the agenda and know that we will have many more today. I think we have 22 people lined up to talk on Zoom about wind energy. So right after lunch. But starting off our committee meeting today will be our Chief Investment Officer from the State Treasurer's Office, Mr. Patrick Fleming, has joined us to talk a little bit about ways that we can find additional revenue through investments and perhaps the current state of the market and where Wyman's investments are. I know the Capital Finance Committee gets all this information, but I think it's important for more members, especially those of us on the Revenue Committee, to have kind of a basic understanding and overview of our investment portfolio, where almost 20% of our spending money comes from based on our investment returns every biennium. So with that, Mr. Fleming, welcome to Revenue. Thank you for joining us on a couple weeks notice, and the floor is yours.
Thank you, Mr. Chairman, members of the committee. My name is Patrick Fleming. I'm the Chief Investment Officer for the Treasury, the Treasury Department. So, per Chairman Zwanitzer's comments, we did just meet briefly a couple months ago, and I just wanted to just tell you a couple things that's happened over the time as far as the markets are concerned, and then we can go into some of the topics that are being discussed with our investment funds committee, our state loan investment board, and also the capital finance committee, which we had a meeting yesterday on. First and foremost, as far as the markets are concerned, the big changes have been with the announcement that at least 2 of the phase 3 trials from the COVID vaccine makers, Pfizer and Moderna, have been released, which show approximately a 95% efficacy, which is much higher than what the market has been anticipating. So with that, what's happened is the market is now looking at, do we look through the short-term weakness and the explosion that we've seen in the recent numbers for the thought process that over the next few quarters, and it's anticipated that by Q3 of 21, that we'll have the herd immunity? Or are we looking at some of the recent slowdown numbers that we're starting to see coming through the market? So it's a little bit of a mixed bag, where the bond market is saying that the short-term weakness is more problematic, and the equity market is saying, well, you know, the long-term we'll be back to normal. So that's what's the best. So we've talked about these slides before. I won't go into great detail, but our debt is still quite high. Our yields are in the 98th percentile now as far as valuations over the last 50 years. So we're facing a very low interest rate environment. The equity market, with the current trailing PE now at 28, that's actually the second highest. There's a brief period for the dot-com bubble when it was the highest at a 30 PE. And as you can see from this graph, when you have that kind of a PE, it's forecasting equity returns in the -3 to +3 from various metrics, which we look at all kinds of different metrics, but here I think is a telling sign to just show how expensive the market is. Now, it's not to say that it can't get more expensive. We saw that numerous times with kind of the animal spirits in the equity market, but just typically when you see these types of valuations, the next 5 to 10 year returns are muted from what we've seen historically. So getting to the meat of the conversation, I just want to comment on a few things that we're looking at. And as you know, the State Loan Investment Board sets the asset allocation, and we focus on producing alpha, or a return above that benchmark. And so with that, there's a few different things that that we try to focus on, but also that we have certain restrictions that I just kind of want to comment on that has that is a little bit more problematic for us. And one of them, as you know, well, statutory limits that we have is the maximum that we can have in the permanent mineral trust fund, for instance, is 70% in equities. So when you look at, most people think of equities as stocks, But the definition for equities from the state is not only stocks, but also what are called alternative assets, which would be private equity, real estate, and hedge funds. So basically any asset that has leverage is considered an equity. So with that, when you compare our returns to some other returns, they do not have the same restrictions. And the other issue that we're going to talk about here, I'll mention later on, is liquidity that we have to have. And we have very low reserve requirements or reserve funds of the investments versus the spending policies. And I'll address that issue later on. Another very large issue that we have is our definition of income. So we have defined income as interest income, so the income coming from bond interest payments, dividends, which obviously come from stocks, and then also realized capital gains. And so with those numbers, what you have, that is the money that then supports the state. So what the largest issue is the how we address unrealized capital gains. So for the most recent numbers that we have, which were last August or September, I believe, we have $1.3 billion in unrealized capital gains. So many of you might say, well, why don't you just sell them and turn around and buy them back? But that is that would cost you millions of dollars, and it really doesn't get you anywhere other than just moving it from one part of the balance sheet to the other. It's extremely inefficient and cost prohibitive, and it goes against many rules, prudent investor rules, all kinds of things that would prohibit us from doing so. But another way of doing it, for instance, Utah sovereign wealth funds, they just look at it as from an accounting perspective. And so one of the ways they look at it is they say, okay, well, let me step back. The other issue that we have, as you know, is our funds are inviolate, meaning we cannot spend principal. So how you can look at this, which other funds do from an accounting perspective, is they look at whatever their cost basis of their assets would be, is what the fund's value would be. And anything below that, you could not go below, you could not redeem from that fund below cost, or that's the inviolate nature of the fund. But anything above it would be within the spending purview of the state. So if that's the way that we worked it, for instance, then that would open up the $1.3 billion in unrealized gains to potentially be able to fulfill our spending requirements. So these are some of the issues that we're facing. New Mexico, for instance, their funds are not inviolate. So they have a spending policy, I believe, of the 4 or 5% or whatever, and they just have requirements. You can't increase that, so it's still somewhat inviolate, but for sure you're going to get that spend. So there's many different state sovereign funds that go about this issue differently, but this is something that all of the entities that we've already met with and discussing about are focusing on to see if there is a better way to be able to skin the cat, if you will. Because if you look at these numbers that we have, I wanted to just show you how our projection, these are income projections. They do not include capital gains. So with that, we're not able to forecast in the goldenrod or anything else of potential income because we don't know what the capital gains will be. But it just shows that some of the problems that we have, as I've been mentioning in the last meeting, in this meeting, when you have the lowest, 30-year treasuries at 1.5%, or 80 basis point for 10-year treasuries, or 20 basis points for three-month euros. This is an extremely low yield. And one of the biggest problems that I have is, if assuming that we're not going to go negative, it's a very asymmetric bet. We can go up slightly in a 10-year treasury, but if you go down, it's problematic. A 1% move in a 30-year treasury would result in a 24% loss. That's it's called duration, but this is problematic because of the risk adjusted return of our fixed income port. Bonds are supposed to be safe, and I would argue that they're anything but safe in this environment. So the next slide, this is what we've talked about before, when we're saying, well, can the market bail us out, and can we have, higher returns and so forth? And what I'm saying is just mathematically, on the fixed income side, it's mathematically impossible for it to happen unless we get 10-year treasuries. They would need to approximately go to a -4% return to get the same type of return that we've had over the last 10 years. And I think that's just near to impossible, because you can do all kinds of things before you would pay the government 4% a year to borrow. The other area that we're exploring is, can we change our definition of equities? So as I mentioned before, equities are stocks and then alternatives. So it's really an antiquated measurement of risk. Because, for instance, as I just mentioned, a 30-year treasury has a duration of 24, or a long bond portfolio has a volatility of about 18%. Our preferred equity portfolio, for instance, which yields 4.5 to 5%, but that is equity, it has a volatility of half that bond portfolio. And so one thing that we're looking at is, why not, kind of go to what most people do in looking at this and use a volatility assumption of what is your risk, or what should be in that 70% of the bucket, because we still should, it makes all the sense in the world to have that 70% bucket of risky assets and then 30% savings. But how you define that risk is the most critical question in what we're looking at. So without going into great details, it's called value at risk. There's all kinds of different metrics you can use to when you're looking at what type of risk that you would want to take. But it just doesn't make any sense when a bond portfolio, which is supposed to be extremely safe, has twice the volatility of certain equity investments that we have. So these are things that we could work on the just the asset allocation decision. Another area that we'd look at is our liquidity profile. So I got back, and we're going to go into more detail on this later on, but our spending policies. So the reserve fund in the permanent mineral trust fund, for instance, is about 300 million. And so that's a little over about 1.5% of our annual spend. Our consultants say you need at least around a 5-year spend liquidity buffer to be able to withstand down years. So if you're looking at that, our reserve requirement, just say, rough and dirty, would be around 1.25 billion is what we should have in our reserve funds, and we have a fraction of that. So the other question, and what we're looking at, is if we could change this around to look at a different way, the accounting structure. If we could use those unrealized gains, for instance, as a reserve, then all of a sudden we would be able to take more illiquidity risk. So let me just explain what are some of the assets out there. So for the same credit quality, we could sell certain fixed income portfolios, which is our core bond fund. It yields right now 1.1%. It's called the Bloomberg Barclay Aggregate, and that's the vast majority of our fixed income. We could sell some of those funds at 1.25% and move into a less liquid investment that has the same credit rating, but might be illiquid for 2 to 5 years, and pick up anywhere from 2 to 5% in yield. We're precluded from doing that right now because we have to have a certain amount of liquidity. And so these are some of the issues that we're focusing on to be able to try and change what we're doing now to potentially get a higher return without increasing our credit risk. So what we're doing is we're substituting illiquidity for a higher yield. And that's what many funds are able to do, is buy more of these illiquid or private market assets to get a higher return. Another area is our internal funds, which are about 25 or 30% of the funds. We're not able to use derivatives, futures and options, if you will. All of our managers are able to use it. And we're not talking about using derivatives in the sense of, oh, wow, we love the market here, let's just go buy a bunch. But for instance, with our asset allocation, if we have an illiquid asset or a way to get a large position on, if we buy a future, we have the position on immediately, and then we can sell that future as we add the underlying assets. It's a much more effective and efficient way of managing money. Also, from risk mitigation, there's certain things that you could do where you can do put strategies or covered call strategies to try and enhance your return. None of these derivative uses would ever increase the leverage of the fund. We're not talking about increasing leverage. We're talking about potentially being able to be more effective and efficient in our management. International versus US dollar assets, which I talked to you on the last time when we were looking at a 60-40, it's assuming US assets will do better. That is assuming that the dollar is going to do better, that public markets will outperform private markets, et cetera. So one area is looking at other exposures to international assets that have a higher yield and a higher probability of currency appreciation. And one of the more important factors that I would argue is flexibility and allowing us to have more time to spend on investments, which I mentioned before, but I just don't spend. I spend 70% of my day on admin and 30% on investing, which is completely opposite of what it should be. So the treasurer is working hard to try and free up some of the things that we do, but also, just from the political process, which I'd mentioned before, as you all know, with the Occidental deal, which I was very supportive of. We were putting in a bid at a 7% yield, which in this environment, if you looked at it, and what the winner did is they put it into a debt structure that still has an investment grade rating. So that would be somewhat equivalent to that 1.2% that I mentioned. And yet that was a 7% yield. So there are opportunities out there, but when they saw that, by mandate, really the SLIB board had to talk about this in public, they ostracized us from the bidding process. They completely excluded us from looking at that. Just having this flexibility to be able to do things which other sovereign funds do has been is an area that we're looking at. The treasurer has commented on us looking at us as a similar structure to WCDA, which is basically a subset, a separating entity of the government. It's still a government entity, but it's segregated and doesn't have some of the restrictions and red tape that we'd have with what we do now. So these are just a few of the areas that we're looking at. I'll go on to the private credit opportunities. I don't want to go into details here. It's much more time than what we want to spend on, but this kind of just shows you some of the opportunities that we could do is if we had that liquidity ability to go into a less liquid asset, what kind of returns we would be receiving versus our current 1.2% yield in the Bloomberg Barclay aggregate. So here's the part of our reserve accounts. So as I mentioned, the PMTF has 307 million. With that Craig projection, which we're looking at these income levels right here for the PMTF, and then we look at the spend, that reserve, because anything if you have a mandatory 2.5 spend into the PMTF and the 5% mandatory spend in common school. So if you have that shortfall, it goes to the reserve account. And so by looking at the Craig assumptions, that PMTF reserve is projected to be depleted by 2024. common school by 2025, higher ed by 2022. So these are some of the issues that we're looking at with these reserve accounts, showing that they are inadequate to be able to fulfill the requirements that we've done in the past because of the lower interest earning environment that we're in. And here, I kind of talked about this before about the reserve. I've already kind of mentioned this, but these are some of the, other things that we've talked about, the, private equity lockups or infrastructure and so forth. So all of these things, they're well known. We're comparing ourselves to other funds and some of the problems that we have, which I mentioned, and some of the opportunity sets that we could do that hopefully, whether it's legislative or just with the SLIB board, that would free us up to allow us to get a higher yield, because we all are on the, the same boat here and trying to increase our return and yet not take significantly more risk due to the fact that these asset classes are extremely risky right now. So with that, Mr. Chairman, I'll stand for any questions.
Representative Western, go ahead.
Thank you, Mr. Chairman. Mr. Fleming, I appreciate you making the time to come chat with us. And just, if you wouldn't mind giving a real quick synopsis, what is private credit and how does it work? I mean, I know, KKR and Carlisle, some of those guys have gotten into it, but just for the folks listening, what is it and how does it really work? In, 2 minutes or less.
Mr. Chairman, Representative Western. So what it would be is private credit would be anything, as you know, public credit is just a corporation or a government issuing a bond. Private credit would be an area where a corporation or other entity has a fixed income instrument that they put into a private structure, meaning it is a non-public. They don't issue the debt vis-a-vis any of the New York Stock Exchange or any of these other markets. So here is an example. For instance, one deal that we're looking at right now is Wells Fargo has these loans with the forbearance that the government is instituted. So many mortgages are non-performing because of the forbearance. Well, what happens with Wells Fargo is that will hit their capital adequacy ratios. So that means that they have to put in more capital into these loans that are not current, even if they know that that's just a government mandated thing. The loans aren't necessarily bad, they're just not paying. So what they do is they package all of these loans and they sell them at a discount. Then an entity will then repackage them and issue them out again once they're paying is again. And that would be an example of a private structure. For here, repurposed performing loans, RPLs, non-qualifying mortgages, repurposed performing loans. These are loans that were not performing, and so they have to fall out of these government, the Jenny, Fannie, Freddie type of bucket. They're repackaged and then sold again, and they're at a higher yield, as you can tell, low to middle or low to single digit yields. They still have their 80+% loan to value, but they're just repurposed. HELOCs, home equity line of credits. So they package all of these together. So there's all kinds of these different types of, more risky would be airline receivables or lease. So the airlines that don't have the cash, they have to buy the planes. So you purchase the airplanes and then lease back to the airline companies at various loan to values. Does that answer your question, Representative?
Mr. Fleming, yes, it does. Thank you.
Thanks. Other questions from members on the committee? Representative Sweeney, go ahead.
Thank you, Mr. Chairman. Thank you, Mr. Fleming. That was terrific. And could I ask you on, first off, I truly appreciate all of your good work on the Occidental deal and The amount of transparency probably cost us the deal, in my opinion, which would have been terrific for the state. But on the unrealized capital gains, are there people in the private credit landscape, the slide that you've got up, are there people out there that need that kind of tax situation that you could sell those unrealized capital gains for somebody else to use and have a better investment tool?
Go ahead, Mr. Fleming.
Mr. Chairman, Representative Sweeney, yeah, it's an interesting concept, and we've gone about this numerous ways. But no, well, one, we're not taxable, so it doesn't hit us, but it would be the owner of the asset. So as soon as we sold the asset to another party, we would be selling it at the market value, not the cost basis, which would then cause us to realize that gain at that time. And that's the problem. You know, theoretically, we go to, and not all of the 1.3 billion is realizable. Many of them are in private structures that I mentioned have a longer lockup that you can't touch. So it's not like we could just sit there and magically create the 1.3, but a big chunk of it is in equities. And so we could go to one of our equity managers that has an index fund and say, okay, on the market close, sell all of them, and tomorrow morning buy it back, and that would realize the gains. But it would have a significant bid offer spread. It wouldn't pass numerous rules. It would be outlawed versus our investment policy statement and so forth. So there's other ways that we're trying to work around where you wouldn't take that multi-million-dollar hit by doing it, but looking for other opportunities to try and take advantage of it. And one is, as I alluded to, is just looking at it as an accounting deal where if we changed our structure to just say anything above cost basis is the fund that would be available for our spending policies.
Thank you, Mr. Chairman. So you had mentioned earlier on the 1.3, if I understood you correctly, that we aren't counting that on our overall portfolio. That's kind of tucked away. Did I understand that correctly?
Mr. Chairman, Representative, yes, you did. So our definition of income, which is then given to the general fund, is dividends, interest income, and unrealized capital gains.
Okay. Thank you.
Thank you. And so committee and actually members watching, I just want to make sure I hit this point home before I get to Representative Connolly. Because in our budgeting landscape of the goldenrod and our fiscal profiles, we do not profile capital gains. Wyoming has been blessed for the past 3 bienniums, certainly, where we have gotten a dump of about $400 million, $350 million each biennium that has refilled our coffers. And so while that hasn't been profiled, it drops in generally at the end of our biennium, goes into the LSRA, which has made the LSRA look very nice. But with this presentation and the state of where we're going the next 10 years, we can no longer count on that 300 or 400 million. And that's not even profiled in, you know, the what was $1.5 billion deficit. Now we've cut that to be balanced, at least in the current budget. I'm just making sure you all know we've had 10 years of an amazing financial run through our investments. And I guess my question then, Mr. Fleming, I don't think we're getting back there, but how, I guess you've mentioned how difficult it's going to be to even hold our spending reserve accounts, and they're projected to decline the next 3 years to nothing. I guess how grave is it is my overall question. And Do you think we can achieve the 5% reserve accounts, or are we going to have to change those numbers because there's just no way to get that kind of return?
Mr. Chairman, yes, you made some very good points. And that's one thing that I do want to comment of, just to make sure everyone realizes, of that 1.3 billion, we typically do realize a fair chunk. I don't have the exact numbers, but we could have 200-300 million in realized capital gains every year. So we do realize a significant portion of that, but it's all through the changes of our asset allocation. That's the biggest one when we have an asset allocation change. Or if we're moving from one manager to another, if there's a manager who's not outperforming or we're doing away with an investment bucket, then those gains and losses will be realized at that time. So we do realize a significant portion of it, but we never, since I've been here, I have never once realized a gain just because somebody said, hey, let's get some money to spend. Mr. Chairman, getting back to your point is, I don't have the crystal ball, and so I don't know where the returns are going to be. But we know for a fact, if we just look at this, these income numbers are derived from where we're getting income. So as I said, the Bloomberg Barclay aggregate is 1.2% right now. Dividends, the S&P 500 is yielding 1.5% right now. So we get those, and then we get some of the realized gains, and then the other areas that we're looking at, we have preferred stocks, master limited partnerships. They're yielding between 10 and 14%. There's all kinds of different types of investments that we're trying to boost the income on wherever possible without taking additional risk. But Chairman, I can't answer your question other than what we have forecasted and the information that we know. If you could tell me where the S&P is going to be in 3 years, then I could answer it. But the best guess is these numbers that we have here, that without either, as you either have spending cuts or increased income. But as we're projected now, these funds, these reserve accounts will be depleted by these timeframes.
Representative Connolly, question?
Thank you, Mr. Chairman. Actually, I think I have three, if that's okay.
Be gentle.
No, in fact, thank you, Mr. Fleming, for being here and the wealth of information. So ultimately, I think and I hope that we do talk about some policy changes that are possible that could help in terms of the investment. But could you talk for just a little bit about what the impact has been of some of the policy changes that we've made in the past 5 years? I mean, we're not doing something different. What we might do is specifically different, but I think in the past 5 years, we've allowed or encouraged you to bring in internal money managers. That I think it was an Amendment A that allowed for the investment of certain funds in different kinds of ways. Have those been effective mechanisms in order to increase our return?
Mr. Fleming?
Mr. Chairman, Representative Connolly, yes, that for instance, we have, when I started, one person retired and I was the only person managing, $19.5 billion. It's, it was just crazy to be able to be effective. Now that we have 7, we have implemented the internal trading that we talked about, but I just reported to the Capital Finance Committee and also Investment Funds Committee. The first quarter, we have produced around $45 million in alpha, meaning above that benchmark, which is our stated goal in the first few months. That would never be possible without those positions that you mentioned. So having that flexibility to be able to do that. We're now, the person that I hired, he's been on for about a year, and we have our systems up and running. And hopefully by the beginning of next month, we'll start trading equities internally. The models that we use that will increase, that will have anywhere from a 2 to 4% alpha above the benchmark. So we're doing all of these different programs, which we feel will be extremely helpful. So yes, to answer your question, it's been extremely important that we've been able to hire funds. And you approved 3 more positions for us effective January of 21. So we're in the process now of putting out advertisements to hire 3 additional investment staff. So yes, it's been wonderful.
Another question
Thank
from
you, Mr.
Connolly?
Chairman. More follow-up just on that one. I'm curious too about Amendment A, I think it was called Amendment A from years ago, and the ability to invest certain funds differently. But I remember we were fairly conservative or cautious about which of those funds you could be doing kind of a more risky investment. How is that going? And is there any discussion about increasing the number of funds that would fit into that category?
Go ahead, Ms. Fleming.
Mr. Chairman, Representative Connolly. Yes, so for the at the time, the mandatory maximum amount for the PMTF was 55% in equities. So now that we're at 70, because the equity market has been the best performing, we have been able to enjoy much higher yields than we would have at 55%. Right now, we're at 64% in the PMTF. So we still have 6%. And we've been, reluctant to go 100% in just because the valuations have been so high. But we did add in the March swoon, we did increase that amount by 4%. So we are trading around those numbers to be able to do that. The difference between the various funds, the SLIB members have segregated our permanent funds into more total rate of return or kind of an endowment, the highest return possible, versus more of an income focus. The income focus funds, for instance, higher education and common school, because of that mandatory 5% spend, they need to have a higher income. And so those returns are going to be lower because of the income focus in those funds versus the PMTF, which will be able to go to up to 70%. So those have been the delineation between the two because of the spending needs. So again, getting back to my point, and this is a great point that you raise, if we didn't have to worry about that 5% spend, we would therefore be able to go into higher yielding assets that would produce a better return. But right now, because of this, 268, it's basically a one-time coverage. You're not allowed to, just common sense is having a lot of riskier, higher yielding assets. And it's a very conservative portfolio.
Okay.
Thank you, Mr. Chairman. Mr. Fleming, just follow up. How much did we save from not paying external managers?
Mr. Fleming?
Mr. Chairman, Representative Connolly, I believe we're at 33 million in savings per year. So our basis points, I think the best way to look at the savings in funds or how you compare to other funds is the amount in basis points that you pay in management fees versus your assets. And I believe we're at 23 basis points right now, which is by far the lowest number within the region of any of our neighbors. That is a very, very low percentage. And we're able to achieve that by bringing in that outside management internally and also go into other managers and index funds that have a much lower management fee.
Yep, go ahead.
Well, this will be my last. So first, thank you so much, Mr. Fleming, for implementing that and implementing it well. And for the newer folks that are here, know that that's something that the legislature debated, and we did it, and we saved tens of millions of dollars, it sounds like, by ultimately making that decision 5 or 6 years ago. But here's my last question, and you had mentioned the Oxy deal, and so I just am curious if there is anything else out there, given that the bond market rates are so low right now, thinking about, for example, future capital construction that might be on the plate, we have had this affinity for paying cash for everything. But would we be saving money if we instead took advantage of the incredible low interest rates that exist right now for projects that we have on the docket.
Mr. Fleming.
Mr. Chairman, Representative, a few different points. Let me address a couple of them. First, one thing I just want to comment on your comment about implementing when we implemented that fee savings, because we were able to spend up to $3 million of that fee savings. So our target is we have to save at least 6 million per year, and we're around 30 some. So we're very good on that. But also during that time, I was at the legislative meetings, and also our SLIB board has said they do not want us to take significant amount of risk in our trading portfolios. So that is something that our investment funds committee has stated, saying, well, why don't you take more risk in your trading and see if you can get higher returns? And I've said, well, the SLIB board has stated they do not want us to take higher risks. And I was at the legislative meetings when I know it was either the House or the Senate that 3 representatives or senators said that if we don't perform, we'll do, well, yeah, they said, well, what's the downside by doing this? And they said, well, if they don't perform, we'll just fire the staff and go back to an index fund. So that's another area that people are saying, you should be taking more risk to try and get a better return. So that's another thing that I wanted to address of opportunities. Getting back, to some of your other questions by, looking at how much you could save from the bonding. When I presented last time, I'm obviously not supposed to say my personal opinion on things, but how the market perceives borrowing and what it's, typically the idea or thought process on it is if you're borrowing with the ability of like a project or something to be repaid, then that makes sense with these very low rates. But if you're borrowing just because rates are low and you're kicking the can down the road, and then you could become state of Illinois or Kentucky or some of these New Jersey states that just have very high debt levels and no ability, then from the textbook case of when you should and should not borrow would be called into question about, is this the right way to do it? So to answer your question, if you could borrow, for anyone out there with a 3 or 4 or 5% mortgage, you should refinance immediately. Home equity line of credits, you could borrow. If you could do this for 30 years, absolutely, because you have the cash flow and the income doing it to support it, and you'll have a house that's appreciating. If you're just borrowing to borrow, then the textbook case would say, no, you should not do that, no matter what the rate would be.
Good. Representative Connolly.
I'm good, thank you.
Other members of the committee have a question for Mr. Fleming? As I'm scrolling through cameras real quick, I'm not seeing any. Well, again, Mr. Fleming, thank you for being with us this morning and discussing our portfolio. And I know Cap Fin is working with you on perhaps some statutory changes, and if those come to the full body here in 2021, hopefully this committee has a bit more information on the need to be at a higher level of competition, because the future ahead is not going to be as easy in the investment world as the last 6 years have been. I think we can all agree. So with that, any closing comments, Mr. Fleming?
No, thank you, Mr. Chairman, for having me on here and being able to explain the situation that we all face. And thank you all for your time and understanding and trying to look at this, and hopefully, we can do some things in a more productive and efficient way. Any questions that you have, please send me an email and I'll respond. Thank you for your time.
Representative Hallinan, you do have a question. Go ahead.
Thank you. Thank you, Mr. Chairman. Mr. Fleming, one of the issues that we could borrow for, I think, is the Interstate 80 toll road. And I think that would be a really good investment for our state. What do you think of that as an item that we could borrow money for at this time?
Mr. Fleming.
Mr. Chairman, Representative Howland, that is exactly the issue or an idea that would be perfect for borrowing at this time. Because, and you look at toll roads, there's all kinds of toll road bonds out there. That's typically how they finance this. But that is perfect way to do it because, truckers are not going to go I-70 or 90 to bypass us to save a few cents. And so in that instance, you have the ability to adjust the revenue of the tolls to compensate for the bond payments. So that is 100% accurate in the type of projects that I was referring to, that it makes all the sense in the world in this low environment to be looking at, in my opinion.
Thank you.
I think he'd like to answer your question there.
I think I did too.
All right. Well, thank you, Mr. Fleming. Enjoy your morning. Committee, next up, we have a riveting discussion on potential legislation for this committee on an income tax. As the bill is drafted over those making $200,000. It is in your meeting material minutes and posted on the web for anyone watching at home. I was hoping Mr. Anderson, if you're available to, I guess, walk us through the structure of the bill. And I believe we have at least 9 people wanting to make public comment on Zoom and perhaps some in the audience here. So Josh, take it away and we'll kind of see where the conversation takes us.
Okay, Mr. Chairman. So first off, I'm sure everyone on this committee remembers last year when we were all in Pinedale and we talked about the national corporate income tax or national corporate tax recapture. And this bill is, as in your materials, is roughly 90+% similar to that one. So I try to avoid too much of a duplication, as you should all be fairly familiar with the structure of this. Main differences in this bill are the definition of the taxpayer and of course the exemption of the first $200,000. And Mr. Chairman, just before we get started, I sent you an email and posted on the website this morning a draft amendment to this bill. So this bill is the same as what was introduced last year by Representative Connolly. It, as introduced and as drafted, would apply to both personal income and business income. The amendment and the way this was noted on the agenda is that it was for personal income. So the amendment that you'll see out there would accomplish that and just make it only personal income and not business income. I didn't know if you wanted me to go through that as I walk through the bill or how you wanted to approach that.
So committee, when we requested this to be looked at, it was not my understanding that the business income would be included. Let me double check with Representative Connolly if she remembers that differently. That's why the amendment was drafted, to take that portion out. But I guess I'm going to look for guidance from her, as it was originally her bill, if she would like it left in for the time being and discussed before we.
It really is the prerogative of the committee. It's cleaner, a bit cleaner if we look at it just as personal. Representative Obi-Miller has other ideas when it comes to corporate taxation. And so it would be fine to take out anything other than personal at this point.
So Josh, if you just present the bill as with, and you don't need to go over those sections then, and when we discuss the amendment, perhaps if we want further clarification on what the bifurcation would be, we can talk about it that time.
Sure, Mr. Chairman. All right, so obviously first page is the title. If you'll note in the amendment, there's one change there, adding Wyoming Personal Income Tax Act. Over on to page 2, and I guess to note, this starts in 102, which is the administration. There's a 101 definition section that will be at the end of the bill because that's already an existing statute. So that's in the amendment section in section 2 of the bill. So we'll get to that later. So section 102, starting on page 2, this is the administration. This is similar to a lot of our other tax chapters, as far as that the administration is vested in the Department of Revenue. This does ask the Department of Revenue to administer this in accordance with the multi-state tax compact. Subsection C on page 2, you'll see the department is directed to obtain information from the Federal Internal Revenue Service, and also then to adopt rules and regulations to implement this chapter. Subsection D is notices. Subsection E is confidentiality of information obtained by the department. And again, this is all very similar to the confidentiality provisions in our other tax chapters. And that takes us through to page 5. That this section, subsection F on page 5, says that the district court of the county where any violations occur has jurisdiction. And again, this is all similar to other tax chapters. And then specifies that no person may fail to make a return as required, or file a false return, or evade payment of tax. And again, this is all similar to our other existing provisions. Bottom of page 5 is the imposition of the tax. We have the taxable event where there's an income tax upon the taxable income of each taxpayer in this state. Here again would be another proposed amendment to add the word personal income if you wanted to make that change. Over on page 6, subsection B, this is the apportionment of personal income. So that if a taxpayer has no personal income outside the state, then the full amount of their income would be apportioned to Wyoming. If a taxpayer has income both within and without the state, then there would be a fraction over on the top of page 7, where the numerator is the total income earned in Wyoming and the denominator is the total income everywhere. Subsection C, through the rest of this section over through page 16, is apportionment of business income. And again, this is exactly the same apportionment that we went through last year with the National Corporate Tax Recapture. And I saw there was a question, Mr. Chairman.
Representative Sweeney, question?
So I got a little confused in this section on, so I think we have a few, say, state employees, I'll use that as the example, that actually work in Cheyenne, but domicile in, say, Loveland or Fort Collins. Is that what this is contemplating?
Mr. Chairman, in a way, so in that case, I think the full amount of the income would be apportioned to Wyoming because the full amount would be earned in Wyoming. It would be if, people have jobs where they earn money both in Wyoming and in Colorado, they would only be taxed on the proportionate amount that they earn in Wyoming.
Okay, thank you.
Go ahead.
Okay, Mr. Chairman. So again, here, if you wanted to change just to personal income tax, I think we could delete starting on page 7 at line 11 through page 16. But just to go through this real quickly, this is the apportionment of business income, similar to how a lot of other states do it, where you have the 3 factors of the property factor, the payroll factor, and the sales factor, and those those amounts are divided by 3 to determine how much of the income would be apportioned to Wyoming. And that carries us over to page 16. And again here, if you were following the amendment, you would delete lines 1 through 7 of this section. Subsection J allows the department to require taxpayers to provide additional information related to apportionment and allocation of income. And there would be some minor technical changes to that section in the proposed amendment. The taxation rate, Mr. Chairman, bottom of page 16 is you'll see 0% on the first $200,000 of income. Somehow muted myself, Mr. Chairman. Again, on to page 17, there are no specific exemptions or licenses or permits under this section. For the compliance section, this requires people to report their income under this section 30 days after the date they're required to file their federal income taxes. Over to page 18, if a taxpayer has a return indicating less than $200,000, the department may waive the requirement to file that report in the future, provided that if their income exceeds $200,000, they're still required to file a report. Page 18, line 9. If you were changing to just a personal income, you would delete the rest of that sentence after $200,000, and the balance of page 18. This is related to how affiliated groups of corporations are required to file.
Did you mute yourself again, Josh?
You did.
Sorry, I don't know how I'm doing that, Mr. Chairman. My apologies. So again, yeah, that would be a deletion of through page 21, line 16. Subsection B there is payment of the tax, and payment is required at the time the report is filed, which would be 30 days after federal income tax is due. Over page 22, this is enforcement. These enforcement provisions are largely the same as our other enforcement provisions in various other tax chapters in Title 39. So you'll see subsection A are the audit provisions. Subsection B over to page 23 is how interest is calculated. You'll see that's a minimum of 12% and a maximum of 18%. Bottom of page 24, subsection C are the penalties. Over to page 26 are the lien provisions, and page 27 are tax sales. Bottom of page 27 is section 109, taxpayer remedies. Here, interpretation requests. This allows the taxpayer to request the department to provide interpretations of the statutes and the rules adopted by the department under this chapter to help determine how to pay taxes. Subsection B is the appeal section. You'll note, similar to many other chapters, it requires taxes, penalties, and interest to be paid prior to an appeal. Subsection C, bottom of page 28, is refunds. Again, similar to how we do refunds for overpayments or mispayments for up to 3 years. Bottom of page 29, credits. You'll see this allows a credit for all excise, sales, use, severance, and ad valorem taxes paid in the tax year by that taxpayer. This is due to our constitutional requirement to allow credits. This is a little broader than what's specifically required. The Constitution only requires credits for sales, use, and ad valorem taxes. So this specifies all excise taxes as well as severance taxes, which aren't specifically required by the Constitution. I see there's a question, Mr. Chairman.
Go, you see a question that I don't, oh, Representative Sweeney. Go ahead again.
So on those credits or back against your personal income, could you list those again? And that by doing that, that makes it constitutional?
Go ahead, Josh.
Correct, Mr. Chairman, Representative Sweeney. Yeah, so the Constitution requires a credit for all sales, use, and ad valorem taxes paid against any income tax. This, as written, is a little broader than that. It provides a credit for all excise, sales, use, severance, and ad valorem taxes. So other excise taxes and the ad valorem or the severance taxes aren't specifically required to be credited under the Constitution, but they are provided in this section.
So Mr. Chairman, so you'd be able to deduct your property tax?
Mr. Chairman, yeah, that is correct. You would be able to deduct and receive a credit for your property taxes and any sales and use taxes that you can document that you paid.
Thank you.
All right, go ahead.
Thank you, Mr. Chairman. Over to page 30, it does clarify that if your credits exceed your tax obligation, you would not be eligible to get any kind of refund for those credits. And then bottom of page 30, Mr. Chairman, and over to page 31, statute of limitations set at 3 years. Again, this is very similar to how it's handled in other tax chapters. Bottom of page 31, this is the distribution, and over to page 32, you'll see that as of now that is left blank for committee discussion as to where you wanted to have these taxes go, whether to the general fund or elsewhere. Mr. Chairman, on to page 32, this is the amendment to section 101, which previously was a preemption saying that local governments were not allowed to impose an income tax. So it adds a new subsection B for definitions. You'll see in general, the definitions of the Internal Revenue Code apply to this chapter unless otherwise provided. Then you see there's definitions for business income. And here I would, you'll see in the amendment, add a sentence at the end of that to clarify that business income does not include personal income, as well as adding a definition of personal income that you can see in that amendment. Again, tax year, taxable income, bottom of page 30 or middle of page 33, the definition of taxable income, I would add the word personal on line 16 before the word income. Over to page, on 33 then, there, you'll see there are adjustments to taxable income, which is the amount reported to the Internal Revenue Code, and then further adjustments to come to a final number that would be used to apply the tax to, with various reductions and increases. You'll see there's an increase for any sales, use, and ad valorem taxes paid that were deducted from your federal income taxes, so that because you're going to be able to get a credit for those in Wyoming. You'll see there is a change there on bottom of page 34 in the amendment to strike the word "and net operating loss deductions," as that wouldn't apply to personal income. As well as on page 35, deleting subparagraph G, which applies only to business income. Mr. Chairman, over to page 36, the definition of taxpayer. Again, I would add the word on line 36, or page 36, line 3, before income, add the word personal, so that it's person who has taxable personal income in Wyoming. On page, section 3, on page 36, you'll see that this is the department's directed to adopt regulations by January 1, 2022, and that's the year this would go into effect. And I'll let the department talk about whether that's a feasible date or not. And I believe that's essentially the bill, Mr. Chairman. I take any questions.
Right, and real quick for the committee and for people watching us, the amendment that Josh referred to is listed as 1401 on the website. That it just has proposal for personal state income tax. It could have probably been defined better, but it says proposed amendment. And so the changes Mr. Anderson talked about are reflected in that amendment to just make it a personal income tax above 200,000. Wanted to make sure the committee knew where that was, as well as people watching. So with that, any questions to kick us off on the statutory construction from Mr. Anderson? Seeing none at this time, let's first go to the Department of Revenue. Mr. Noble's been here a long time, so I know he's not going to advocate for or against the bill. But I guess the question before you, Mr. Noble, is the legislation workable and what would it cost to implement?
Good morning, Mr. Chairman, members of the committee. I'm Dan Noble, Director of the Department of Revenue. I just received this amendment just a few minutes ago, and it does change our estimate. I'm not sure exactly how it will impact it. To include severance taxes and everything else on it as credits against this, and other excise taxes might make this much less palatable as it relates to the actual amount of money that it may generate. I don't know, because what we've actually included in any modeling we've done in the past has been sales and ad valorem taxes associated with this. The other thing is, I'm curious about business income being excluded and what that actually would entail, because on every return that's filed, we've from a person that's self-employed, they file either Schedule C or Schedule F. There's partnership income. There are pass-throughs of subchapter S that flows through into these accounts, and I'm just curious as to where does business income start and stop. If you're talking about Schedule C income, that would obviously have to be removed from the taxable income that is reported on the federal return. We'd have to look at what these other incomes are that would have to come out, and then recalculate it based on what is truly personal income. I'm not really sure where what corporate income tax does not get reported on this form. The only thing that gets reported on this form from a corporation, unless it's an subchapter S or an LLC, is the income of the CEOs and things like that. The rest of it is reported on a corporate return. So I don't know that I understand what it is we're trying to remove here. It certainly changes how we would model this income tax, but I mean, we can certainly try. I just don't know whether it's I can look to see how much income is reported on a Schedule C and how much is reported on a Schedule F, but that is certainly included in the numbers that I gave you in the past few years. It certainly will change the way this looks.
Fair to ask you, if we leave the bill as is, to talk about where we were in the projections, We haven't officially passed the amendment yet, so
Okay.
perhaps
Mr. Chairman, I think the only thing that I'm unsure of, and I think it has changed since the last draft of this, is the inclusion of other excise taxes. That would include fuel tax that is paid. Those are excise taxes paid by individuals. You're talking about severance taxes. Those are paid by businesses. A lot of it would depend on the structure of the business that you're talking about there. If it's reported as self-employment income on a Schedule C, they may very well be entitled to that as well. I just don't know what it would look like. It's just something that, you know, I mean, does other excise taxes include the tax on alcohol? I mean, we all pay that if we drink, and I do. So,
drinking.
so I guess the question becomes, those are not constitutionally required. Obviously, sales taxes and property taxes are specifically stated in the Constitution. The others are not, but it is something that I think you need to be aware of. It would change the way this looks. And I don't know to what extent it would. What is reported on the federal tax return that we glean from federal information is sales taxes and property taxes. And those are in the spreadsheet that Representative Conley has been referring to, that I have worked with for a number of years.
Let Senator Case ask you a question real quick. Mr. Noble, go ahead, Senator Case.
Thank you, Mr. Chairman. What I think is those of us that are really looking at this income tax, Mr. Noble, we kind of look at the practicality of it. And it seems that the mineral industry has carried Wyoming for so long that I don't think there's a lot of appetite for hitting them with another super tax, and that allowing them to deduct the severance taxes paid seems pretty fair. I think that's pretty universal among most of us. So I'm not sure that that's new. And besides, you know, this is possibly going to end up being a personal tax. Right now, of course, it's not. I would prefer that it not be just a personal tax, but the severance tax is the big driver. Fuel taxes, that will definitely have some effect. We can decide whether we want to allow that deduction or not. But I think the alcohol tax and things, let's just say, no, we don't want to do that. And give you some guidance. If this bill moves forward, which it may not, my guess is it probably won't. But for those that are advocating this and it'll probably come back as an individual bill, we really need the department's help. And it's like, I always feel that you're really dragging your feet on this one. And let's be more collaborative about trying to figure it out. I really would appreciate that help.
Why don't you agree, Mr. Noble?
Or not agree.
I don't know if there's a question in there, but any response you'd like to give on how much fun this is for your department to try to figure out as
It's
well?
really a lot of fun. I'm sorry about that.
Mr. Chairman, I'm not trying to be dragging my feet on any of this. I'm trying to point out the issues that we'll have as it relates to administration, and the fact that I'm going to have to change our estimate because I have to include these other taxes as credits. Now, they're not deductions, they are credits. It's a very big difference in the two. And I'm not sure that you're going to have anyone that's going to be able to claim severance tax on an individual tax return anyway. That'll be done at the corporate level anyway. So I don't see that as an issue, but I do see the other taxes as something that was not contemplated in the past. And that's all I'm saying. I'm not trying to say this is a bad bill. I'm just trying to say that it's going to certainly change the way it looks.
Mr. Anderson, you want to jump in real quick?
Yeah, Mr. Chairman, I just wanted to note that I just pulled up last year's bill, and those were both included in that version as well. That was introduced last year, so it wasn't anything changed with this draft or with the amendment.
Oh, Mr. Chairman, then I missed it.
Representative Swinney, go ahead.
Well, is part of that problem, you know, it was designed as corporate tax to begin with, And I really appreciate Director Noble's comment about the severance taxes. We don't, if this is going to change to a personal, then why complicate things? And the biggest concern I've got is what passes the constitutional muster in Director Noble's. I'd appreciate his comment. I respect his opinion.
I'm not sure Director Noble wants to talk about his thoughts on what's constitutional and what isn't, just to be safe. So, and not hearing specifically another question for the department on administration or how this would be affected. We're going to go to Representative Connolly.
Yeah, thank you, Mr. Chairman. So Director Noble, you have in the past produced a spreadsheet about how the bill would work. And I'm curious if you have that and have that available in terms of looking at personal income and kind of those bands of personal income and who would be impacted and the amount of money that would be generated. And honestly, based on what the constitutional mandates. I mean, let's just put aside the inclusion of additional elements because you didn't calculate it on it. And if you have that spreadsheet, could you please kind of show it to us and kind of walk us through like who would be impacted, how many people, and the value of the tax to the state?
Thank you. Mr. Chairman, Representative Conley, and committee, can everyone see the spreadsheet that I brought up?
Yes.
Okay.
Not sure if your cell phone's going, but.
All right. I think probably the best way to talk about this is to look at and tell you where these numbers came from. The AGI numbers that were created here, adjusted gross income numbers that came from here, were from the federal, the IRS, and I believe also the Bureau of Labor Statistics has some of this data as well. And it breaks it down by the income categories that you see in the headings above. And what we did was we went and we looked to see what property taxes are claimed and added those back in to try to come to what the taxable income would look like. Then we assign the tax rate, which is in this instance only begins at $200,000 and above, if you will. And one of the things that I think is kind of interesting to note at this rate is the number of tax returns that we're talking about for people that would be required to file. You've got 8,000, 9,000, 400, about 10,000 people would actually be filing tax returns under this schedule. If in fact others below $200,000 do not have to file a return. So you're talking about 10,000 people would have to file the tax out of, let me see, 278,000 tax returns that were filed in Wyoming, and I believe this is 2017 numbers at this point. So what it does is it calculates what the net or the tax return information it's given and what actual tax would have to be paid on this. You'll see on line 17 there, the tax due on someone making $200,000 to $500,000 would be zero because the credits that are allowed eat up that income. So it would be relegated to those earning over $500,000 to pay this tax. You'd have roughly $315,000 in tax on those making between $500,000 and $1 million, and $107 million on those making over $1 million. You'd end up with $107 million in tax due on an annual basis, roughly $6 million in administrative costs associated with that. Now that could be less because of the fact that we're filing less returns, depending on whether there is a need for a return to be filed by people under $200,000. So the question would be, okay, could we do this for less? Certainly. I think that if we have the time to have the program written for us, as opposed to pulling something off the shelf, we could probably get this this price down quite a bit. But it would take a year or two to get it implemented. That's really what this spreadsheet does. It talks about, okay, the property tax analysis is down below. Those numbers are pulled up into the information above. And I can adjust this to include what it would look like if you went to other levels. Let's say that you went to people making more than $75,000 a year. Obviously, it still doesn't impact it much as it relates to how much tax you're generating until you actually put a 4% tax on pretty much the entire population. And you can see that when you run this across, the amount of tax is being paid by those making starts between 25,000 and 50,000 starts to increase it quite a bit. If you're making under 25,000, you do not participate in this. What that would do is raise roughly $296 million, 289 after administrative fees. But as the tax currently exists, it's like that. And that's basically what the spreadsheet does. As it stands, what we were estimating was that it would raise about $101 million. If I were to add in the other excise taxes, I'd have to look to see what that distribution looks like. I don't know that we would be able to provide anything other than a total, because I don't know that the feds actually capture any of that data because they don't include it as a deductible expense. I can certainly look though.
So Mr. Noble, looking at that chart, even if we initiated this at $200,000, the actual tax due for anyone making under 500,000 would be offset by the credits.
That's
That'd
correct.
be a fair assessment. So,
Mr. Chairman, that's correct.
and further looking at that chart, we're only talking about $315,000 for people making under $1 million, where the bulk of the revenue really would be those making $1 million or more in Wyoming. I mean, 107 million to 300,000 to try to get that smaller subsection in. I mean, is that even worth it, I guess, for people making under $1 million? Maybe, and that's, I guess, a political question you can answer. Let me ask you a question you can answer. When we talk about single filers versus married filing jointly, would we base this per individual, or if a married couple was still making under, let's say that, one spouse made 250 and the other made 100, they would fall under the 200 threshold if they average their income like they would do with the IRS. Would that be the same as a state income tax in Wyoming?
Mr. Chairman, I think a lot of that depends on how the returns get filed at the federal level. Most of the states that deal with this start either with the adjusted gross income or taxable income on the federal tax return itself. And that's something that would already be baked into those numbers. So we're just taking what we have here off of what was reported by the feds themselves to the feds from individuals that file on a 1040.
Okay, thanks. Questions on the spreadsheet for Mr. Noble? I'm scanning cameras as quick as I can. I saw a hand and it's from Senator Beitman.
Thank you, Mr. Chairman. Thank you, Director Noble. A couple of questions. Number one, do we know how many taxpayers, what's the number of taxpayers that do fall into the million plus bracket in the state of Wyoming? Do we know how many specifically there are?
Yes, I believe I messed something up here. Just a second. There it is. When you look down here, one of the things that gets reported to the feds is the number of tax returns by area of distribution. You're talking 880 tax returns that were filed in excess of $1 million. So I would say, obviously, if this is family income, you could probably add people to that, but the number of returns filed over $1 million was 880.
Okay.
Out of 278,000 households that filed returns to the feds in Wyoming.
Okay, and this is essentially a best case scenario, assuming that those 880 people don't leave the state after we pass this. Second question is, how would somebody walk me through how the deduction or credit for sales tax would work? Do I need to keep track of all my receipts now, and at the end, when come tax time, now I've got to go through and add up all the sales tax that I paid throughout the year to deduct that from my income tax? That's going to be a nightmare. How is that going to work?
Mr. Chairman, Senator Beitman, the IRS actually has a formula-based table that you can use that kind of estimates based on what your income bracket is, what you could expect to receive as far as a sales tax deduction, if you will, and that's the way it's done at the federal level, sales tax deduction. And you can utilize that table, or if you have one or two outstanding expenses that are way over that, such as the purchase of a new vehicle or something like that, you can use the estimate and add in those large expenditures that require a whole lot of sales tax being paid in one transaction. That's the way it's done at the federal level. Property taxes, it comes off of I believe it's a 1098 or something like that, one of those forms. So that's easy. You just demonstrate that's where that property tax number came from. But as far as sales taxes, the feds utilize an estimate for states like Wyoming that don't have an income tax, and allow you to use that table to make that happen. We could probably do something very similar to that in Wyoming.
Thank you.
And Mr. Noble, would I be correct that, I guess 95% of taxpayers are now paying through an electronic system. And those systems are set up as well by state to throw the correct numbers for those states who charge an income tax. I guess my interesting question, especially for Wyomingites, after the new tax laws last year, the standard deduction is so much higher for the majority of Wyomingites than itemizing. Historically, a lot of people would itemize all of their taxes paid, and as of last year's tax period, the standard deduction as a nation, Wyoming gets a huge benefit, at least in my opinion. But so many fewer Wyomingites, when I looked, are filing that standardized deduction. They're just filing to itemize. They're just taking the standard. And so as a number that's turned over to the state to collect income tax based on that standard deduction, or they would still do an itemized for Wyoming specifically to try to hit our constitutional requirements. My ultimate question is, I think there are three major competing in the marketplace, maybe four people you pay your taxes through. They would all have the capability, if you know, to use our statutory structure in their system with like 6 months notice or something.
Just stay in the dark.
Yeah, let's stay in the dark.
As far as filing an electronic form, Mr. Chairman, I think probably what we would do is, and I think a lot of states have done this, is that they approach companies like TurboTax and other providers that do this, and basically establish the income tax rules, work with that company to try to get that resolved. Then I think we would also probably, as part of development of this software to handle this, we would probably develop our own electronic system to make it so they could file using our system as well. As it relates to the standard deduction, you're correct. I do as well. I use the standard deduction. And what we would probably have to do in order to ensure that these sales tax credits are are done appropriately is we would have to still utilize the Fed's table to determine what sales tax would have been included under the standard deduction, back that out as a deduction, and then re-implement it farther down the form as a credit against the income, against the tax. That's how I think that we would have to handle it in order to make it work.
Thank you. I appreciate that for my lengthy question. Representative Roscoe, question.
Thank you, Mr. Chairman. Director Noble, if we were to simplify it and just use the federal adjusted gross income as the number, how would that affect all these other numbers? Would it include the credits or not? And then my second question would be, do other states that have this kind of a personal income tax, do they use an adjusted gross income, which would really simplify things? And then do they use as a 4% kind of comparable to other states? Thank you, Mr. Noble. Mr. Chairman.
Go ahead, Mr. Noble.
Mr. Chairman, Representative Roscoe, I've looked at a number of states, North Dakota, I've looked at Nebraska, and there are credits that are offered. In a lot of instances, it's for things like child care credits and things like that that are even offered under the federal tax law. But a lot of different credits are offered. I don't see, and granted, I haven't looked at all 50 states, but I was not able to find a state that offers a credit for sales and property taxes paid under this. Now, some of them, obviously, because of the fact that depending on where they begin their taxation, if you're looking at taxable income versus AGI, you can certainly create some different scenarios there as well. But to tell you the truth, I don't know that I could find a state that offers specifically a tax credit for sales and property taxes paid. That's strictly looking on the states that I've reviewed, and it is not an exhaustive search. I'm sure there's probably some others that can testify, can tell you if there are some states out there that do it, but I was not able to find any. If it's simpler, if you go with, and states across the board have different starting points for where they begin with taxable income. So if you start with a federal number and we have to recognize then that there is sales tax and property tax included in that return if that person is paying either, and obviously the sales tax is being paid. Not all people pay property tax. Those that are renting do not get those 1098s that show that they're paying property tax. That actually goes to the landlord. But you got to recognize that probably is baked into their rent. I just don't know that you could actually say that they're paying property tax when in fact they don't receive that form.
Okay. Further questions for the department before we get through a whole lot of public comment? Okay, seeing none. I'm gonna try to, I think we have at least 8 people when we probably should get some people in favor. Oh, Mr. Tempe, you wanna go first? Go ahead, from LSO.
Well, thank you, Chairman Zwanitzer. This is certainly not public comment. However, I just wanted to point out the Department of Audit also submitted an estimate of administrative impact for the bill from last session. They looked at the bill that was online for today, but not in the context of the amendment that was submitted. But they did provide an estimate of their administrative cost as well. They indicated there still would be an administrative cost because they would need to hire employees for auditing this new tax as well. And just as a ballpark, that estimate was roughly $1 million a year. They quoted a number of employees of 9 new employees. That estimate as well did not include space rental. At the time they submitted their estimate last year, they did not have that information available at the time. I do not know, and I don't know if they know how the changes proposed in the amendment being discussed would change their estimate, but I just wanted to remind the committee of there's an agency besides the Department of Revenue that would have an administrative impact related to this bill.
Questions for Alyssa? Okay, seeing none, let me go through who wants to jump in first. All right, Mr. Noble, go ahead.
Mr. Chairman, just one clarification as to why that number of people might be needed.
Sure.
Well, this bill may only contemplate a need for roughly 10,000 people out of 278,000 to file a tax return. That doesn't mean that we don't have to audit those that are making less than that to ensure that truly is what is happening. So there is some administrative impact associated with the verification of those making less than that as well. And that's really, you got to understand, whether we make them file a tax return or not, there is still an income tax on those making over 200,000, and that has to be verified in some way, shape, or form.
Okay. Thanks. Mr. Merrill from the ESPC, you want to go first? Welcome to Revenue.
Thank you, Mr. Chairman. I'm Chris Merrill, Executive Director of the Equality State Policy Center. Thanks for the opportunity to talk today. It sounds like you have quite a bit of public comment on this, so I won't take a ton of your time. I did submit written comments, and I'm not going to rehash those, but I am here to testify in support of the concept of an individual income tax in Wyoming. And if it's okay with you, Mr. Chairman, I'd like to share just a few slides here.
Sure. For the time being, we'll make sure they're appropriate.
I promise. So I just kind of want to give you a sense of what's going on in some other states in terms of a personal income tax. This is Utah, and you could see here that the rates graduate, from 0.3% to a top marginal rate of 4.4%. And this is North Dakota. It's more modest, 0.2 up to 1.7%. Idaho, similar to Utah, the top marginal rate is 4.6% on income tax. Very similar in Kansas, 4.4% top marginal rate, and it graduates depending on your income there. This is Nebraska, again, very similar. And this is Montana, very similar top marginal rate. And this is Oklahoma, similar, a little more modest. And this is Georgia. Now, I want to suggest that you might want to consider, as opposed to implementing an income tax based on a certain income tax level, because of the wisdom of our Constitution, we have the opportunity to consider just a flat tax for everybody. And so I want you to imagine a flat tax, for example, a flat tax of 8%. In this case, if you're in the lowest 20%, if you're earning less than 26,000, you're not going to pay any state income tax. If you're earning less than basically 50,000, you're not going to pay any state income tax. And then you start paying a little bit once you get over 50,000. And the top marginal rate there would be like 5.4%. If you considered a 7% flat tax for everybody, then that won't really kick in an income tax until you're making over 70,000. And then the top marginal rate there would be 4.4%, something very similar to a lot of our surrounding states. So that might be a way to go when you're considering a personal income tax in Wyoming. Just consider a flat tax for everybody, as opposed to singling out a certain income level. And that might be a little bit more fair, first of all, because it's, you pay a little bit more the more means you have. And we don't even, because of our constitution, we don't even really have to mess with dialing knobs in terms of like what the progressive tax would look like. You can just allow people to get credit for their sales tax and their property taxes, and that that kind of graduated thing you see in other states, it will kind of play out naturally in Wyoming. At least that's my sense of things. I will of course defer to experts like Mr. Noble on all the things I got wrong here, but it seems to me that might be something you can consider to maybe simplify things and maybe make it feel a bit more fair to the people of Wyoming. And with that, I'll stand for any questions.
Questions for Mr. Merrill? No, center case, maybe? Go ahead.
Thank you very much, Mr. Chairman. So, Mr. Merrill, I'm kind of intrigued by the flat tax idea. I think you and I have kind of visited a few times. On the face of it, a flat tax is certainly not a progressive tax. In fact, kind of regressive on that face. But I'm intrigued by your thinking that because of our Constitution and the credits that have to be applied based on other taxes paid, that somehow that would undo the regressivity and maybe overcompensate for it. And I have a little trouble with that, especially with since we don't tax food, for example, which is arguably the most regressive part of it. But I'm partly intrigued in a positive way because I've always felt that our discussions about individual taxes in Wyoming being progressive or regressive miss the totality of our entire tax structure, and the fact that there is some offsetting things for all of us in terms of regressivity, progressivity, because the mineral industry carries the bulk of the whole freight in Wyoming. So can you talk more about why you think it comes out that way? Maybe more progressive in its end than regressive because of the constitutional credits?
Mr. Merrill, go ahead.
Mr. Chairman, Senator Case, I think the way I'm thinking about it is, as it stands now, with the lack of an income tax, any income tax whatsoever, Wyoming has one of the more regressive tax structures on its face in the country, because as a percentage of your income, as I showed you in that one slide, the less you make, the more you pay in taxes in Wyoming as a percentage of your income. Now, to me, the essential step in fixing that, a lot of people call that an upside down tax structure, is to implement an income tax. And because of the wisdom of our Constitution, we can essentially accomplish or go a long way toward fixing that regressive structure by simply implementing a flat tax that credits people as our Constitution requires for the sales tax and the property taxes they pay. And given that credit, if we set that flat tax at the right level, say 6, 7, 8%, then it will by its nature be progressive. And in total, the taxes people pay will be more progressive in Wyoming than they are now.
Okay.
So, Mr. Chairman,
Go ahead, Senator Case.
I'd like to go into that a lot more. And I look forward to that in the future. I don't think it will pan out that way, but I also need to make the point that even though it's regressive on its face, our regressivity compared to actual taxes paid by people in the same income tax bracket or tax bracket for all these types of taxes in other states, we're completely different. So as an excise tax, for example, on goods, a sales tax imposed in Wyoming, we could break it up into all these income categories. But if you took those poor people in Wyoming and compared how much taxes they actually paid compared to the same income category of people in any other state, I think we would come out to be less, they pay less taxes. So it's within our tax system, it appears regressive in the sense that we understand about disposable income and what you buy. The math is there. But when you compare everybody's situations, because of the mineral industry in Wyoming, we are all paying less than we would if we were the same income category in any other state, including the very poor. I want to get with you and spend all day talking about this, and we could use some help. And I appreciate you bringing it up. I don't think it pans out like you might think it does, but I could be wrong. It really could be. Thank you.
So the question to you, Mr. Merrill, was would you check with Senator Case later today and discuss with him taxation policy?
Not today.
After he recovers from this meeting. Brooklyn Conley, do you have a question for Mr. Merrill?
I do, Mr. Chair, just to clarify, and I too am very intrigued about the conversation that is going on between Mr. Merrill and Senator Case. And in particular, I'm curious about, Mr. Merrill, your analysis as it relates to, in particular, our taxation of property at 9.5% of assessed valuation. That to me seems to make us very different than other places in the country. But that being said, just to be clear about your testimony, is it the testimony of the SPC that you would like to see this bill go forward, but without the $200,000 exemption and with a higher rate? And if that is true, what is that higher rate that your organization is suggesting?
Mr. Merrill.
Mr. Chairman, the simple answer is yes. Yes, Mr. Chairman, Representative McConnelly, that is the intent of my testimony. We do support this bill going forward. And I would suggest considering getting rid of that income threshold and raising the flat rate to somewhere between 6 and 8%.
Okay. Further questions to the SPC? Not seeing any at this time. Thank you for being here, Mr. Merrill. Enjoy your Friday. Next up, Mr. Gagliardi from the NFIB. Welcome.
You might say who's on deck because it takes a little bit of time.
I have been chatting people privately, letting them know they're up.
Perfect.
Welcome. Yep.
Thank you very much, Mr. Chairman and members of the committee, and good morning. My name is Tony Gagliardi. I'm the Wyoming State Director for NFIB, the National Federation of Independent Business, and we represent over 2,700 small business owners up in Wyoming, and was prepared to testify totally against this proposal until I heard about the amendment and the suggestion that we just totally exempt all Schedule C income for a business owner for the fact that 95% of the businesses, small businesses in Wyoming are classified as pass-through businesses. And the income earned by the business stays in the business and is used to expand the business, new plant and equipment. And the bottom line, it creates new jobs. And then any leftover is transferred over to the individual's income tax return, personal income tax return. And we have all heard the old saying that perception is reality. and our concern about any conversation about whether it be a new corporate income tax or a new personal income tax is it stalls investment. And I think at this time with our economy, we cannot be doing anything that would stall or create hesitation for one to invest either in new business, in a startup, or creating new jobs. That's the most important thing. In listening to the conversation from the very beginning this morning, I really do agree with some of those comments that have been mentioned, that this issue needs what I feel would be a tremendous amount of consideration and discussion. And as far as the discussion goes, it must be, it's imperative that all the players be at the table at the same time to discuss this. And I would agree with Senator Case that there is so much to the this conversation around taxation, and whether it be flat tax or incremental, that I think we have a long ways to go. I don't think this proposal is ready for prime time yet. I do think we need a lot more conversation. And at this time, we would, NFIB would oppose in this proposal going forward. So with that, I'm happy to answer any questions. I know you've already had a long meeting, and I appreciate the opportunity to join you.
We appreciate you joining us. Questions for the NFIB committee? Not seeing any. So thank you very much, Tony, for appearing before us today. Always a pleasure to have you in our committee.
Thank you.
Thank you. Thank you, Mr. Chairman and other members.
Next up committee, we have Phyllis Roseberry. Good morning, Phyllis. Welcome.
Good morning. I'm not quite sure how to start my video.
It's on.
Do you see me?
Yep.
Okay. Thank you so much for allowing me some time before the committee. I really appreciate it, Mr. Chairman and members of the committee. I'm just a citizen in Wyoming. I've lived here a long time. So I don't represent anybody except my neighbors, friends, and family, whom I've talked to extensively about our current situation in the state. So I'm speaking in support of this bill. Like I say, I've lived and worked in Wyoming for 45 years. I live right outside of Worland. And fortunately, our children ended up getting jobs here. So both our children and grandchildren live here. And I do love this state. And I'm very fearful of the abyss that I think we're galloping towards. Fortunately, we live in a country where we have some control over our destinies. And it would be our tragic choice if we decide to jump into this abyss, dragging our children with us. In my view, this choice would be to live in a state of denial of reality and to act irresponsibly as the adults in this situation. So market forces, we all know, are driving the fuel industry, especially coal, into a lower or non-existent market share. Yet we are clinging to the past. So I think that, yes, as everyone has said, the fossil fuel taxes have supported our public services, and they're waning. And as many people have stated, probably will not return. So if we value our children, we will have to look for more sustainable revenue sources. To drastically cut our school budgets will result in crippling the ability to build the skills in our state and our children to compete in the future economy. We will become a backwater poor state with no hope for its people. The income tax bill offers a fair solution to this problem. It offers a revenue stream generated from the wealthy. At this point, when I wrote this, the businesses and corporations were in there and residents of our state. Many of these entities are from out of state and use Wyoming as a tax haven, thereby taking advantage of our services but not paying their fair share. Do we choose to cripple our people's future to provide a free ride for the more wealthy people? Responsible legislative action could remedy this situation. So I believe that because this income tax revenue could be used, for example, to support our schools, to me, it's less of a tax than an investment in our future that we make communally as a group. I mean, our schools are funded communally, not individually. So we need to work together to keep them afloat and the high quality that they are. So I just fear about spiraling into a dark world and we're going to drag our children with us. So I looked up some information. Apparently, you probably are aware Kansas made some big tax cuts. I think it was in 2012. And 5 years, I mean, they went through some turmoil, political, economic, tax-wise, and, you know, it was a big struggle. They finally corrected the situation after a lot of fights, but their children and citizens had to suffer through 5 years of crippled schools and state services. So to me, why go through that suffering to come to the other side and say, gosh, we should have done this in the beginning? So I urge you to vote yes on this reasonable bill that would affect, and I don't know what the percentage is now with all the changes, but I thought it was about 2% of our more wealthy people. So I'm asking you to please be the adults in the room. Our children are depending on us, and support this bill. So thank you so much. Oh, and I was going to say, my husband and I make nowhere close to $200,000 a year, but I would be happy to pay some income tax to keep our schools the high quality that they are and our other state services. I would be happy to. Okay, thank you.
Thank you. Before you go, any questions, Ms. Roseberry? Representative Connolly.
Thank you, Mr. Chairman. Ms. Roseberry, then would you kind of, when we hear arguments, for those of us who have been thinking about this issue for years, about whether or not there should be what I would call the two-tier system, where the reality is that only those at the very, very highest brackets are paying the tax, to one that, for example, Mr. Merrill just suggested that we take away that kind of that first tier of income and instead have a slightly higher income tax rate. So it would impact more people.
Yeah, I think we should share in communal support of what we all enjoy. So yeah, I would be willing to. And like I say, the friends, neighbors, and family I have visited with, because we're all so scared about what's going to happen to our state, they said, sure, we'll throw some into the pot to keep things going. So yeah.
Okay. Appreciate
I would agree. Yeah.
All right. Well, thank you very much for being with us this morning. Certainly nice to hear from members around Wyoming, just from the public who are involved. Yeah. So appreciate your involvement. I hope you have a great rest of your day.
You too. Thank you.
Next up will be Mr. Sesser. I hope I'm saying that right. Tyler, welcome to the Revenue Committee. Floor is yours.
Thank you, Mr. Chairman and members of the committee. I am actually representing the Wyoming Engaged Council. For those of you that know, we are about empowering the next generation to advance and grow the economy. So this is right in our ballpark. This is something that we are deeply invested in. It's really exciting to see this on the table and to hear your comments from all of this morning, and to see such deep thought about a new solution, a new revenue strain to ease the burden on some of our others. As some folks in here mentioned, minerals aren't going to be the place where we can see that relief. They're struggling right now too. So this is exciting to see. Across the demographic for Engage, we serve 18 to 35-year-olds is our focal point. As somebody from that demographic, one of my concerns with where we're looking at in the next couple of years. You know, seeing this morning that some of these funds are going to be depleted by 2024 and 2025, knowing that we have a 4-year lifeline even before COVID. I'm really concerned for folks like my daughter, you know, who's 3. In 2 years, I'm wondering what educational system she's going to have access to, what learning opportunities she's going to have access to, and that's deeply concerning, you know, to me to see, you know, the 16% cuts that are proposed in Casper. I live in Trona County. It's hard in to see those cuts. It's hard to see cuts into the arts and cultural realm, that we make our community stronger and create that platform for people that want to come here and live here. So that's something that we've heard across the board is, as one of the previous speakers here mentioned, the younger generation is worried about what's going to be there for them and for their children in the next several years. And without some reasonable revenue measures, it's increasingly bleak. So we know that, you know, cuts, I think it sounds across the board here that we're recognizing that cuts aren't going to get us out of this. They're definitely going to be necessary, obviously, but finding new revenue streams is going to be huge. Seeing some of the information about a flat tax, and that, you know, the net tax on constituents in Wyoming, I too am willing to put in some more money, you know, for the services that I receive. I think the figure is something like $30,000 for every $30,000 that we receive in services. I think I and individuals only pay $3,000 into that for state services. So I'm willing to contribute more than that, even though I'm not in that $200,000 bracket. So if by the committee's decision you need to move that down and start taxing at a lower bracket, I think many of us in the demographic are very interested in supporting our community. And then lastly, I just want to share that I know that we're through the Tax Foundation, we're seeing that you know, we're set 47th in the nation for the lowest property tax rates. In some of those areas that we can move up a little bit, and in some area and still not be out-taxed or out-taxing, you know, our neighboring states. And then with some of those cuts, as somebody in the arts and cultural realm, I'm increasingly worried about the balance between tourism and infrastructure. I know that we have a lot of history in tourism and bringing people here. It's kind of what saved our revenue this last summer, right? Is that we saw more tourism and more people coming to our state even through COVID than we had anticipated. But if our infrastructure is not meeting that demand, I know that the YDOT brought multiple measures up for consideration, and we're not able to get those funded. And that makes the roads less safe and makes the roads less appealing, and will have a negative impact on our tourism. And that's something that we in the arts and cultural realm really rely on, is that constant influx of people. So thank you, and I'll stand for any questions as well.
Questions for Tyler? Not seeing any at this time. Thank you very much for being here this morning on behalf of the council, and keep up the good work.
Thank you, Mr. Chairman. Thank you, committee.
All right, next up we have Michelle Humber, I believe. Welcome.
Hi, thanks so much for having me. I am a citizen of Wyoming. I live in Pinedale, Wyoming. And my husband and I have 2 little girls that go to Pinedale Elementary. They're in 1st and 3rd grade. And so I am in support of the bill. I'm particularly worried about cuts to education. I went to the parent advisory meeting the other day, and it's really concerning, the cuts that the schools are facing. And I want to say I am not a Wyoming native. I've lived here for about 11 years. I'm originally from Georgia. I'm married to a Wyoming native, and I love it here. I've actually loved Wyoming since I was a little girl, and I feel really grateful to live here. I remember when my husband and I, decided to have children, I looked into the education because I wanted to make sure that I wanted to stay here. And I was so impressed with with Wyoming's education system and, you know, the money and the thought and everything that you're willing to put into education. It's super impressive, and was definitely one of the reasons that we wanted to stay here. And I think that, and I know that this bill wouldn't just support, you know, I know you have to dole out the, you know, what the money would go to and everything, but I specifically want to speak on the education part, because that's what I am most concerned about. But you know, I think that you need to think about the fact that families, when they're moving here, they look, I mean, I know first thing as mothers that we look at education and we look at, you know, what kind of education is going to be offered for our children. That's one of the main things I think that families look at when they're moving to a place or when they're wanting to stay at a place. So, you know, and I think that as far as businesses here go, if you want businesses to thrive, you have to have people that stay here, you know, and I really worry with all of these cuts that we're going to have a mass exodus of people going other places. And that just wouldn't be good for anybody. It wouldn't be good for our economy, for our businesses. I also know a lot of people that work in education, and education. To make these cuts, they're going to have to cut teachers. They're going to have to cut personnel. And so all of those things are things that I'm really concerned about. And I think we have to be proactive in finding ways to, you know, fund education, arts, all of the things that make Wyoming so great. You know, it's awesome. The public lands, you know, being out in the mountains, that's one of the things I love, because it's so different here. You know, I can go out into the mountains and not see anyone. And that's just such a wonderful part of this state. But the other part is the investment that, you know, Wyoming has made into education. And so I think that's something that we really need to think about, you know, long term, that this is, like somebody said before, this is like an investment into our future, because, and you can see from other states that have cut funding like this and then not replaced or not found any other source of income to replace or to supplement that funding, they've done really poorly. And I don't want that to happen here. I want this to still just be a thriving, you know, state like it's been. And like someone said too, you know, it just doesn't seem like the revenues that we've had in the past from, you know, oil and gas and coal are going to get any better. And so I think we need to think ahead. And like everyone, the other two people said too, I am also willing to pay income tax. My husband and I, we're not anywhere close to 200,000 either, but I am willing to pay if that's what it takes. So yeah, thank you so much for listening.
Thank you. Any questions from Sumber? Seeing none. Representative Yen, is that a question? Welcome.
It is. Thank you, Mr. Chairman, for recognizing me. Ms. Humber, I appreciate you giving testimony, and same with the representative from Engage, especially given the idea of thinking about what the future looks like, how we educate our kids. So my question to you is essentially, do you think that your family or your friends and their families who have kids that are, or are looking towards education in Wyoming, if our education system degrades to the point where you don't see it as a quality education anymore because we're not able to fund it, do you see your family or your friends' families moving out of Wyoming because of that? Thank you, Mr. Chairman.
Go ahead.
Yeah, absolutely. I do. I mean, you know, it's not something that I would want to do, but I think that, you know, we have to. The thing about living in such a rural state is, you know, our kiddos don't have the same opportunities as far as, like, you know, we have to drive 4 hours to go to museums, and, you know, especially in Pinedale, you know, there are things that we can't access here so easily because we are so rural. But with the quality of our education, I mean, it just really hasn't been a problem for us. I'm just always so impressed, you know, when my kiddos come home and tell me about, you know, what they've learned, and I see how much the teachers care and everything. And it makes a huge difference. I actually worked in the North Carolina school system, which is one of the, it was at the time, it was one of the poorest education departments in the state. Sorry about the phone ringing. And it still is. And I don't want my children to go to be in a school system like that. The classes were huge. The teachers were overworked. It was a much, much different environment than I have felt here, in Wyoming. And so I do think that you will see people leave, and I think that you will see people choose not to move here. Right now, especially Pinedale is such a beautiful place. I think it's a place that people really look to move to. And, the first thing that families are going to look at is education. So just, please keep that in mind.
Representative Blackburn also has a question.
Thank you, Mr. Chairman. Yes, ma'am. Thank you for coming and testifying to us. I was just wondering, would you be in favor of a tax on food and also a more of a state sales tax?
Summer, your opinion? Go ahead.
The tax on food is tough for me because I know that there are families, especially low income families, that are struggling. Food is really expensive. That's one of the things that my husband and I argue about, because every month he's like, how are we spending so much money? And I'm like, I promise you, I am not shopping. I'm not online shopping. It's food. Food is really expensive, especially here in Pinedale. So I'm not so sure I would be in favor of a food tax. And in all honesty, I don't feel like I have the information, that I would need to have to know what that would look like for everyone. Sales tax, same thing. I'm not sure I know enough about it to really give you an educated opinion on that. But I do think that I would be, I would support taxes that would help, education. But I'm not against taxing, like this particular tax. I'm not against taxing businesses. I know there's been discussion about taking that out, because I think that it would be an investment for businesses, because businesses need people, and in order to keep people here, we've got to make the people need something out of that too, which has been, which is education, I think, is a big part of that, at least for a lot of us. And even for people that don't have, children in our school system, and an educated workforce is just, it's beneficial for any economy. And it's beneficial for getting people to stay here too. The more jobs that we have, when we have children graduate and go to college, they can come back here, which is what I hope my children do, because I want them to live near me. So not sure I have enough information on what that would look like and who that would really affect. But yeah.
I certainly appreciate the answer of understanding everything's complicated. And
yes.
Yes, we strive to get more education on all of these issues. All right, with that, thank you very much for, we have another one. You're popular today. Representative Hallinan.
Thank you, Madam Chairman, or Mr. Chairman, and thank you, Michelle. What I would ask you is, if the cuts in education would not impact the classroom, and if the money that would be available to support our government and our schools could be available out of the savings that we have, would you favor that as well, or as opposed to a tax increase?
I don't, I still would support the increase. I know I'm speaking out on behalf of education, and I would appreciate that, but I don't want the other cuts either, to arts and humanities programs, and all of the other important issues, healthcare, especially right now with what's going on, mental health. I don't want cuts to any of those. So I would appreciate that, I would appreciate funding, out of the reserves for education, but I still want extra funding coming in to cover everything else. So, or to cover somewhat of everything else, I guess.
Thank you.
Yes.
All right, now we're going to get you off the hot seat now. Certainly enjoyed your testimony. Stop back any revenue committee meeting in the future.
Thank you so much.
Thank you.
And committee, I don't believe I have any other public or Zoom testimony coming before us. If anybody else on the Zoom I'm not seeing, jump in. Okay, not seeing any person here public comment on the income tax proposal in the audience here. Not seeing any as well. So With that, committee, we'll close public comment on this topic. Any discussion or motions on the legislative draft before us? I would entertain at this time. Representative Connolly.
Mr. Chairman, I'd like to move the bill.
Okay, moved by Connolly, seconded by Sweeney. Discussion on the legislation. Perhaps the best thing would be to start on the amendment and our thoughts of including that, or taking off the individual business portion or leaving it as one package to move forward. I don't know if you have thoughts on that, Representative Connolly, or anybody wants to make a motion to that effect to move the amendment or not. Since I'm Representative Roscoe.
Thank you, Mr. Chairman. I would move that amendment. I think just for to make it all possible to pass it, I think that would be critical. So I would move that amendment that we take business out of the bill.
Okay, is there a second on that amendment? Second by Sweeney. And so again, committee and members of the public watching, that amendment has been listed on the LSO website. I think it's 14-01 in the meeting materials. And what it does is take out business. I'm trying to think what we're referring to it now as business personal property, those people who are self-employed as part of a business, et cetera, from the bill, and making it solely on what I would say is W-2 income. That's how I explain it to myself. Discussion on that amendment, Representative Connolly, go ahead.
Yeah, Mr. Chairman, I'll support the amendment, but only because I think it does make the bill cleaner, and it honestly is what we talked about at the last meeting. But I would like the committee to know that I would like to work with others who have been interested in the corporate income tax portion of it particularly, and to bring others to the table for an individual level bill. Thank you.
Thank you. Further discussion on the amendment solely right now. Senator Case, go ahead.
Mr. Chairman, I'm not going to be supporting this amendment. I actually think the personal income tax, I'm fine with going down this route a bit, but I think that the corporate income tax is really where we need to be. And I fail to understand the workability of excluding business income from individuals. I mean, when you look at when you file your taxes and you have a Schedule C, and you might have a Schedule SE that you file, and it has income that comes into that from your various business interests. Okay, maybe that's unusual. Not all people have that, but I think a lot of people do. A lot of people. Do we want to exclude that and just go on the wage earner? So I just think it's unworkable. I really don't get how it can work through. So I'll be opposed to the amendment.
Okay. Further discussion? Question being called on amendment from Representative Western. All in favor of the amendment, please raise your hand in the camera. I got 1, 2, 3, 4, 5. Got 5. 6 with Joanne, with Representative Dayton Summon. Okay, all those opposed to the amendment? I got Baldwin, Case, Hallinan, Larson, Driscoll, Western, Blackburn. Okay, that amendment does fail then. We're back on the bill. I hope you all have the bill up in front of you, committee. I know Katie sent it out in email, and it's also in the meeting materials. If there's any certain sections anyone wants to discuss or amend, certainly happy to entertain any motions at this time on the bill draft.
Question.
And I did get a message from LSO that we have noticed this as a personal income tax bill, and it's now also for business. So there may be some difficulty pushing it forward now that it's more than just a personal income tax bill without proper notification. I don't know how anybody feels about that, but wanted to make that known at this time. Senator Case.
Well, Mr. Chairman, I'm kind of guessing that it won't make any difference. But I think we should go ahead and vote it in. You know, remember, this is an interim committee meeting. We still have another meeting to come. And if say we were to pass it, then folks have the entirety of time to whenever our session is going to be and however it would be introduced in a session. I think they'll have weeks at a minimum and months more likely to consider the ramifications of this and be able to fully engage at the time of the session. So I am sensitive to the point about the bill title, and we were trying to be very careful about that. But we actually had a bill on the table that was not what we described it as, and it has been out there a long time. Bottom line is, I think by the time we go through this vote and it fails, then it doesn't matter.
Okay.
Question on,
Yeah, Representative Blackburn.
question on the bill.
Okay, before then, Representative Connolly has some comments. Go ahead, Representative
Yeah,
Connolly.
thank you. Yeah, thank you, Mr. Chairman. Before we vote on the bill, I just wanted to mention, folks, that a year ago, I had thought to myself that I had served 10 years in the legislature and that it was a good time for me to retire. And then what happened is that we went through session, and by the time we got through session, the recognition that where many of us, and those of us who are on this committee as well as on appropriations for years, understood that our economy was changing. We knew it. We thought that we had 5 years, 10 years. There were solutions out there. I've been looking at them for years, this being part of it. But what happened by the end of the session for me personally is the recognition that our economy had switched on its head and did so immediately, that we didn't have the 5 to 10 years to kind of think about the issues, to mull them a little bit longer, but instead that our reliance on the extractive industries could no longer take place. And we needed to address it immediately. And then yesterday, I heard the overview, the fiscal profile from the governor's budget cuts. And if you remember, I asked some questions because I was unclear about that $50 million in addition and the $115 million that was coming off and $500 million in cuts and what it meant. And it occurred to me last night is that if we implement those governor's budget cuts and we don't have any revenue to backfill those programs, our state is going to look wholly different, and wholly different in a way that I don't think, and I would hope none of us want us to go. It means that there are cuts to the Department of Health so deep that our elderly, that are disabled, that our kids are no longer getting even the minimal services that we expect today, that our communities are no longer going to thrive. The revenue just isn't there. We have already seen in so many of our communities what the cuts from 3-4 years ago looked like. We are not going to be the same state that we are today. We're going to lose those young people from Engage. There's no two ways about it. We're going to lose those 18 to 35-year-olds. They're going to vote with their feet, and they're going to move out of the state. So, Mr. Chairman, I'm going to ask the committee that we take our responsibility on the Revenue Committee really seriously, and that we think about how we move forward. This is one way. We're a group of 14 people. Let's let the group of 90 of us have this debate and have it done well on the floor. So, Mr. Chairman, I'm going to encourage the committee to vote aye.
Okay. With that, Representative Roscoe also commentary. Go ahead.
I have a question and a commentary. I guess a question might be for Senator Case. Is there any way to split this bill in the future, maybe, so that I think the only chance of getting anything passed is to separate the personal income from the business. It just simplifies it. So that's my question. I'd hate to lose this altogether because I think that Wyoming is going backwards, and we're actually following the exact same steps as Kansas. And if the if the result is what we want, we're heading in that direction. And I guess my question is, where are we going? If we're just, where are we going as a state? I mean, we can vote no on everything, but what is the end game? I would like to hear that at some point. What is the end game for Wyoming, and what's the end game for this revenue committee? We have to, I believe we have to do something, and so far we haven't really done hardly anything. Thank you, Mr. Chairman.
Maybe I'll go to Representative Hallinan next to have some comments as well, and
Sure.
we can offer our thoughts, I think,
You
towards
bet.
the end. So Representative Hallinan, go ahead.
Thank you, Mr. Chairman. Well, I think that we need to turn down the governor's step 3 cuts. The step 2 cuts, I think, are appropriate, and we have to live with those. As to the amount of deficit that we have, I think that we need to cut education also. And there are ways to do that are within the Constitution and would not impair the classroom teaching. And I think we need to use those cuts to reduce the amount of money that we have to take out of our LSRA. The LSRA is there for rainy days, and that's what we face now. And I think in the future, we may have to increase taxes over and above what we're doing already in this committee. But I don't think it's necessary that we do it now. I think we've got another couple years to see how this COVID thing works out. We may not find that we are in that much of a deficit in a couple years. We found that out in the last 3 months. I think they lowered the amount of deficit expected by Craig by $400 million. So I think it's possible that we will see that we don't need to increase taxes at this time, not to the degree that we're talking about here. So I don't think that it's appropriate to say that we're going to have to cut all these cuts. I think that there are ways that we can do that without damaging these programs so drastically as the governor proposed. So that's my thoughts on this issue. Thank you, Mr. Chairman.
Thank you, Representative Hallinan. I appreciate those. Maybe one clarification of that improved revenue picture of a little bit more than 400 million. That was, I think, about 80% due to the governor's stage 2 cuts of 400 million. So the Craig report got $400 million better, but that was primarily because the governor slashed positions and 400 million. And as you remember yesterday, the 500 million for level 3 is on the table, obviously, for the session. But I would agree, I don't want many of those $500 million cuts to government. And that's just the general side of things. I think this bill, as presented before us, is roughly, we could tweak it to be 200 million, which gets us a pretty strong way to closing the gap and kind of riding the dip until, in my mind, oil will come back at some reasonable level. But we do need to do something to kind of get us so we don't dip past the point of no return and burn out the entire rainy day fund. So to Representative Roscoe's point, I would just say, I believe all 90 of us probably have a different idea of what we want Wyoming to look like in the future. And I think some of that depends on our upbringing. Some of that depends on where in Wyoming we live. Obviously, I live in just the capital city, large amount of government employees, teachers, federal officials. And so we're a very government town with I think, a very different mindset than the people who move to Northeast Wyoming or Northwest Wyoming. And so that what's the end game, I think looks different for each of our communities. But I do know, for the benefit of all of our communities, we've got to do something to get a little bit of revenue on the table. I'm all for cuts as well, and I think they're going to be astronomical, especially to education. Those will happen. But having a mixture that we can present to the full legislature, I think, is important. And this is at least something to say, hey, this is an option that affects, what, 2,000 individuals out of 280,000 taxpayers, which is dangerously close to the 1%, I dare say. And so I would encourage you to move it forward. I know I won't be on the revenue committee, so it's easy for me to say, those of you staying on the committee, please deal with it in session. But I do think it's important to have a couple of ideas, not only for education, for general government operations, and for the roads, to all move forward from this committee. So those are my thoughts. Senator Case, do you have any closing thoughts for the vote?
Mr. Chairman, I do. And first, I would like to address Representative Roscoe's idea that maybe we could split this bill somehow. If we're voting on this bill and then it would go into the session, after we get into the session and after this vote, it would not be possible to split this particular bill in and of itself. You can't take one bill and make it into two. Our rules would prevent that from happening. But nothing would prevent an individual or a committee, but anyone from putting in a second bill that went down one or the other, all business or all just personal. And then this existing bill we're voting on right now could be modified to match up with it, to sort of be the opposite of it. And we do that all the time with conforming bills. When you have two bills that basically deal with the same area, we make conforming amendments. So I think that would be the vehicle to get both options on the table, and encourage us to do that. The conventional wisdom has been that our Constitution really prohibits an income tax, and that it's just not a good idea. It's something that Wyoming said, and that's been the end of the discussion for lots of time. And I mull that over and mull that over, and I think that our Constitution is actually incredibly wise on this, because what it's really saying is, if you put in an income tax, you're welcome to do it, but understand that it's going to impact those people that aren't people and businesses that really aren't paying many other taxes in Wyoming. Well, a big light goes on in my head when I think, that's exactly right. That's exactly what we want to do. We have lots of ores in the water in Wyoming, but we have lots of ores that aren't in the water. We discussed some of it yesterday. We talked about very high wealth people enjoying the amenities and environment of our state. And I'm very glad they're here, but they're not really contributing, at least I don't believe they are, in proportion to other things. We've talked about the contributions of the mineral industry and folks that pay significant taxes in Wyoming. Our state constitution fixes all that. It equalizes that because they get credits for the taxes paid. And I just want to give one example. I've got the Fremont County map server up on my screen. I'd love to share that with you, but I don't think it'd be appropriate because it actually lists a very specific company who has a retail outlet in Riverton, Wyoming. And you can look and you can click on the lots and you can see how much property tax that business, which has revenues in the millions and millions. I would venture, and I have no idea what their revenues are, but they're probably $1 million a week. I'll throw that out to you. I could be right or wrong, and I'm sure we'll hear about it. But you all know about these large big box stores that are throughout the United States and throughout Wyoming. Their headquarters is not located here. And in transition to big box and this kind of retail environment, we have done a lot of things. We've removed entrepreneurs and turned people into wage earners And it's just, and we buy things from corporations instead of from our neighbors now. It's the way it is. I'm not arguing. It's certainly more efficient. It gives people better prices, but it has changed the fundamental nature of our community in that these companies and neighbors that were contributing don't contribute quite so much anymore. So we have a multi-million dollar retail business that has a very large store, and it looks like their property tax, they have two pieces of property here. Their 2020 taxes on part of it are $11,893. And then if I go back and get to the other parcel and look at their property taxes, that one is $47,000. So I might be missing something, but we roughly have 47. We're talking about $60,000 or $70,000 in property taxes. Now that's missing the personal property, the business personal property that's within the store, the fixtures. You guys all know the drill. So I did contact our assessor about that, and I found out what that was last year. And that figure is 84,000. So if I add the 60,000 plus the 84,000, roughly, you know, we're talking 144,000, make it 150,000 for a retail business that has revenues in the multi-millions. I'll say north of 50 million, and somebody can tell me I'm wrong. Now, we're not catching all the taxes. They'd of course be able to deduct their severance taxes. Oh wait, they don't have any of those. They'd also be able to deduct their excise taxes. That would be on the stuff they buy that they use in that store. So if they took stock off the shelves and say it's toilet paper and they put it in the bathrooms, and they should be paying a sales tax on that. But what do you think that is? You know, we're up to 158 million, maybe. Are we going to pick up another 150,000 now with the property tax? Are we going to pick up another 50,000? I kind of doubt it. So let's just call it $200,000. That's the total amount of taxes they pay to the state of Wyoming. And they've made a lot of changes in our communities. I don't think that's enough. I think our Constitution figured this out very perfectly. And there are both individuals and businesses that fall in this category. It's going to be complicated to get the transition to get there. And I understand the Department of Revenue's concerns and all this. But in my heart, I just say, Wyoming's changing as we corporatize for out-of-state corporations to provide retail services in Wyoming. It's changing with highly wealthy people coming into Wyoming. We don't seem to be able to grind out a real estate transfer tax, a property tax with the ag classification doesn't seem to work. This is the only thing that potentially could work. And it works beautifully with our Constitution. I support the bill. I look forward to more changes.
Representative Sweeney.
I just wanted to correct one thing. Step 3, in my mind, is 115 million, not 500 million. Step 1, 2, and 3 all combined are 500 million, is the way I understand it from Don Richards. So just a point of clarification.
Sure.
Thank you.
Yep, and I generally agree with that based on what they submitted, utilizing some of our funds how they want to. But yes, I'm in agreement. All right, with that committee, we have a motion on the table. The second, 2 calls for a question to make bill draft. Let me officially say it for the record here. 21 LSO 144, an official revenue committee bill for the 2021 session. Josh, if you would call the roll.
Mr. Chairman, this is for 21 LSO 144 version 0.4. Senator Baldwin.
No.
Senator Beitman.
No.
Senator Driscoll.
No.
Senator Ellis.
No.
Representative Blackburn,
No.
Representative Connolly,
Aye.
Representative Dayton Selman,
Aye.
Representative Hallinan,
No.
Representative Larson,
No.
Representative Roscoe,
Aye.
Representative Sweeney,
Aye.
Representative Western,
No.
Co-Chairman Case,
Aye.
Co-Chairman Zwanitzer.
Aye.
Closer than expected.
6 ayes, Mr. Chairman.
All right, committee. With that, let's take and if I say 5, it'll be a 9-minute break. Let's reconvene at 11:20. I know we have some people here to talk about sales tax exemptions, but I think we could all use a break for 9 minutes. So back here at 11:20, remind you to take your microphone and your video off.
Kathy, your mic's still on.
So is yours, Pat.
That's why.
All right, committee.
Jeff.
It looks like you can hear me. We're going to come back to order here. There we go. Next up on our agenda today is to discuss sales tax exemptions. We're only running 22 minutes behind, which is great. So with that, this is another thing from the Management Council put to our committee, as well as I believe you have all heard the governor mentioning reversion of some of the exemptions may be a place that's not necessarily increasing taxation, but ways that we could increase some revenue, and we should be looking at all of our exemptions. So with those two caveats and lots of people texting me on my computer, let me turn it over first to Director Noble from the Department of Revenue to discuss tax exemptions broadly.
Mr. Chairman, Dan Noble, Director of the Department of Revenue. We submitted 5 separate reports on exemptions that we are required to track under statute. Would it be okay to go through those first and then open that up for questions and then talk about exemptions on a broad basis? I think this is really what we have before us. And these are actually reports that kind of look at the actual impacts of the exemptions and how they affect the economy. There are 5 different reports. 4 of the reports actually have results to report, and the 5th one has never been used, and that is the coal gasification and liquefaction exemption that has not been used. We are required to report on it, but there's nothing to report, so we'll focus our energy on the others that do. The first report that I'll go into is the effects of sales and use tax exemption for manufacturing machinery. This is the 15th iteration of this report on the use of the sales tax exemption on manufacturing machinery. What we do, and this is common to all of the exemptions we're talking about, is that we send out a survey to all of the potential manufacturers that could make use of this exemption, and ask them, number one, what their taxable purchases were, or tax exempt purchases were during that year. This year we sent out 1,046 surveys, received 520 back, or roughly 49% of them. And of the 520 responses, only 159 of the companies actually made use of the exemption. What was reported, and this is on page 14 of the report, what was reported was 258 million in tax exempt purchases that were made by these 159 companies, representing at the average rate of 5.37%, $13,860,109.20 of exempt tax that was foregone on those purchases. One of the things that we're required to do under this is to look at employment data as well, and to provide some level of the impact, as you will, from both the Wyoming Business Council and the Economic Analysis Division. In this year's version, the Business Council deferred to the REMI analysis of this impact, and on page 18 of the report are the actual results of the analysis. And this paragraph, the first paragraph in it really describes it. The economic impact of the removal of the sales tax exemption from purchases of manufacturing machinery and machine tools used directly and predominantly in manufacturing was modeled in REMI as an increase in the production costs for the industry of $10 million per year, beginning in 2019. The removal of the exemption would result in an average annual loss of 75 jobs and a decrease in gross domestic product of $11.2 million per year over the period from 2020 to 2030 when compared with the baseline scenario. That's actually the results of the analysis itself. And in a nutshell, that's the report. That is actually, there is obviously employment information associated with this, and it breaks it down on a gender specific basis of employment, number of manufacturing versus total jobs in the state. Fairly complete analysis, but the crux of it is the exemption and what it costs the state, and then what the impact would be of removing it, as based on the study using the REMI product. With that, I'll stand for any questions on that specific report.
Any questions from the committee? I'm not seeing any on that report, Mr. Noble. This committee does love reports though, so you're going to get some questions eventually.
All righty. The next report that I'll review is the sales and use tax exemption for qualifying data processing centers, purchases, and rentals. We queried, I believe, 8 entities to determine whether they had made the qualifying purchases, and we received responses from 3. 2 made sufficient purchases to actually qualify out of the 3 that actually returned information to us. There was 194 million in exempt purchases made in 2019, and in addition, 160.4 million in ancillary equipment purchases as well that qualified for the exemption. Using the statewide rate of 5.37% is estimated as 19.04 million in unrealized sales and use tax for 2019. Again, applying the REMI model on page 10, the result was as such. The economic impact of the removal of the sales tax exemption for purchases and rentals of qualifying computer equipment necessary for the operation of a data center processing center was modeled in REMI as an increase in the production costs of the data center industry of $15 million per year beginning in 2019. This exemption removal would result in an average annual loss of 56 jobs and a decrease in gross domestic product of 6.7 million per year over the period of 2020 to 2030 when compared with a baseline scenario. That's the results of economic analysis modeling of using the REMI product. Mr. Chairman, I stand for any questions on that report as well.
Any questions, committee? And I would hope most of you are following along. All 5 of these reports are in our meeting materials, and for members watching on YouTube, they're also posted on the legislative website under the Revenue Committee. Each one are 30 or 40 pages of charts and figures. So at least at this point, my appreciation to the department for all the work that went into calculating. And I know several state employees had to spend significant time, putting these reports together and documentation. So I hope the public and the legislative branch find them extremely useful to know what we're paying out. Senator Case, do you have a question?
Just could we summarize that data real quick again, Mr. Noble? That was, I love these reports now with the REMI connection. And so we're trading off how many jobs for how much tax revenue?
Okay. Mr. Chairman, we lost $19.04 million in revenue from sales and use tax in this report, and this is for the data centers. And the REMI model inputs $15 million in additional costs. If the exemption were to be repealed, they would add an additional $15 million in operating costs beginning in 2019, and it would represent an annual loss of 56 jobs and a decrease in GDP of 6.7 million per year over the period of 2020 to 2030. That's what the results of the analysis are.
So if, may I follow up? So we take 19.4 in the direct tax losses divided by 56 jobs. So we're looking at pretty expensive jobs here.
It's not a question. I don't think, Mr. Noble.
No, we're just, bear with me here.
Yeah.
So that's a bunch of money. That's it's north of $300,000 per job if my math is right. That seems kind of high. I bet.
I think the question, is that number close to accurate, Mr. Noble?
That's a good question.
I'm trying to get my committee to, ask you questions. Does that sound right, Mr. Noble?
Mr. Chairman, I would assume Senator Case just sat there and did the math, so I'm assuming it's probably right. It sounds accurate. As far as the $300,000 per job lost, I would assume that's probably an accurate number. Now, obviously, not all of that is associated with the actual industry itself. Some of it is ancillary, because another aspect of that model is that there's a loss of GDP of a certain amount as well. So obviously, you have to look at it in total, and I don't know if there is anyone from economic analysis that is on this call or not, but they could probably provide you with a little better understanding of the actual discussion of what that modeling is looking like. But I think it's probably fairly spot on, Senator Case, Mr. Co-Chairman.
Representative Sweeney, you have a question?
Yes, this would be to Director Noble, Mr. Chairman. So I can't see, and I probably am missing it, where property tax and personal property tax is contemplated in the REMI model. Am I incorrect?
Mr. Noble, how correct is Rep. Sweeney?
Well, Mr. Chairman, I guess, and Representative Sweeney, I would assume, okay, that when you take a look at the loss of gross domestic product, a portion of that is baked into what could be foregone as it relates to other revenues. But here, I guess the point would be is this is really targeted at what happens if you remove the exemption for sales tax. It doesn't really contemplate the actual property tax issues as well. Now, I do say that over and above the actual loss of employees, it could be contemplated that there'd be a loss of some level of property tax. I just don't know whether that's actual or not. The question would be, would people continue operating these data centers in the state, or would they forego that? And I think that's probably a question that even the model can't answer. It may contemplate it, but it doesn't necessarily answer it directly.
Follow up, Rep. Sweeney.
Thank you, Mr. Chairman. So to that point, my understanding is the very first data center that the state put in is actually now the highest property tax and personal property taxpayer in Laramie County. I don't know that. I haven't pulled that information up, but so I believe that in this whole mix, when you're looking at the jobs in the analysis, because I was like, why are we giving them $10 or $15 million to move here to a gigantic company that has unbelievable worth? But I believe the answer is for all the other positive impacts. And so in the end, I think you do have to put property tax in there. My opinion. Thank you. Thank you, Mr. Chairman. Wouldn't you agree, Mr. Noble?
I don't think I'll put Mr. Noble in we'll just say that's rhetorical. With that, any other questions on the data center presentation? Representative Connolly, go ahead.
Yeah, thank you, Mr. Chairman. And actually, I want to follow up from the last two questioners, and especially Senator Case. Mr. Noble, could we get a kind of just a further explanation of the calculation of job loss and the loss of GDP? I would like to see that and understand it better. So thank you.
Mr. Chairman, Representative Conley, I can certainly work with economic analysis and provide a little more understanding. You know something? I think one of the things, Mr. Chairman, when you look at page 11, excuse me, go back to the right report. When you look at page 10 of the qualifying data processing centers purchases and rentals, it actually does state what kind of loss there is in property tax revenue associated with that. So yes, it is in the model. I I corrected myself, I guess. It is actually contemplated in the model. How that actually is broken down within the model, I can certainly try to get more explanation of how that works, but it is actually part of the model itself. When you look at that graphic that is on page 10, the very last line in it is associated with property tax revenue. It also breaks out the employment by the type of industry that would be impacted by the loss of those jobs. The number of information jobs that would be lost, finance, retail, construction, and all other. So it is fairly well broken out. Hopefully that will answer most of the questions that you may have had at that point.
Okay. Senator Case, did you also have a follow-up question?
Mr. Chairman, I was actually going to bring that up, so I appreciate that. I just point out that the difficulty with all of these exemptions is we're always speculating on what would happen with or without them. We know what happened with them. This is it. But is that causality? Did A cause B? Is this large company going to leave because they have to pay $15 million more dollars? You know, and remember, that's all in the past. We're only going to talk about new purchases. And my understanding about computers, of course, is that they do need to be replaced regularly. So there would be new purchases down the road. But there's an enormous investment here. Wyoming is incredibly advantageous to these companies locating data centers here, in part because we have very low electrical rates, and the local utility here in Cheyenne has been very generous and negotiated very decent rates with this company. And electricity is incredibly important to them. Electricity is not just used to drive the computers. Surprisingly, a huge amount of the electricity load is with respect to environmental controls for the facility, meaning cooling. And we are, again, our geography and our climate is enormously advantageous in terms of reducing the cooling load for these facilities. Add to that our lack of corporate income tax and other advantages. It comes to mind to me that we should not always start this discussion with looking at something like property taxes and assuming that all of that would disappear without this exemption. That is so far from being even conceivably possible. We need to be more skeptical about this, and we need to be more hard-nosed. And this is one that probably should go away. Wouldn't you agree?
Got to start
Somebody
getting into people actually asking questions to presenters here. But Mr. Noble, any thoughts on Senator Case's comments?
Mr. Chairman, I'm going to limit my response to the actual numbers before me. And obviously that is something that you folks will have to discuss as to whether this is an appropriate exemption or not. My part in this is to report on what the impacts actually are, and whether those rise to the level that you folks want them to or not is really a discussion for you. But if you'd like, I'll move on to the next report.
Yes, please.
This is the effects of the sales and use tax exemption for repairs of railroad rolling stock. This, I believe, has been around, this is the 12th edition of this report, been around. And actually this report has gone on and gone off because the exemption has gone on and gone off as well. So it has been repealed, I believe, in the last 20 some years twice and then brought back. There were 8 businesses that responded to our survey as it relates to the repairs of railroad rolling stock. Of those, excuse me, there were 8 people surveyed and there were 6 responses associated with that. What was reported was $22,950,000 in exempt purchases, estimating at a tax rate of 5.37% on a statewide basis. $1,232,459 was the cost of the actual exemption, the sales tax revenue foregone by the exemption itself. And that's on page 3. On page 11 is the analysis of what would happen if this exemption were repealed, utilizing the REMI model again. By the way, all of the reports that we have done have exactly the same scrutiny by the Economic Analysis Division as it relates to the REMI model that has been done under the same circumstances. The economic impact of the removal of the sales tax exemption for the sales, purchases of tangible personal property or services performed for the repair, assembly, alteration, or improvement of railroad rolling stock was modeled in REMI as an increase in the production costs for this repair and maintenance industry of $2 million per year beginning in 2019. This exemption removal would result in an average annual loss of 33 jobs and a decrease in GDP of $2.7 million a year over the period of 2020 to 2030 when compared with baseline analyses. And that's pretty much this report. I think I would say it contemplates all of the same factors as what we had just discussed with the data center exemption. And that pretty much concludes the report as it relates to railroad rolling stock. I'll certainly stand for any questions on it.
Questions on the railroad rolling stock exemption? Could be 3rd time's a charm this year if it comes off. All right, seeing no discussion on that currently, let's move on to the 4th report.
Okay, Mr. Chairman, this report is on the sales tax and use tax exemption for qualifying broadband services providers. This is the first year, I believe, of this report. And we surveyed 62 potential users of this exemption, received 22 responses, and of the 22 that responded, only 5 actually made use of the exemption itself. There were $12,623,615 in exempt purchases made, resulting in foregone sales tax revenue of $677,888 in foregone revenue itself. The REMI model looks at the exemption and the removal of the exemption and what that impact would be. The economic impact of the removal of the sales tax exemptions for purchases of equipment by a telecommunications service provider, video programming service provider, or provider of internet access used to provide broadband internet service was modeled in REMI as an increase in the production costs for the telecommunications industry of $1 million per year beginning in 2019. This exemption removal would result in an average annual loss of 3 jobs and a decrease in GDP of $500,000 per year over the period 2020 to 2030 when compared to the baseline scenario. I think one of the things that I would caution on this exemption itself is the fact that there's not a lot of data points on it yet, and it might be something to kind of see how this plays out over a little bit of time. It's fairly new, and I think when you're looking at something that is a recent exemption, it might be better to have a few data points before we actually start looking at its impact. With that, Mr. Chairman, I'll stand for any questions.
Questions from the committee? Not seeing any on this one.
Okay. Mr. Chairman, the fifth report is the one that I referred to associated with coal gasification and liquefaction. That exemption has not been used since its implementation.
Okay. We had high hopes for that one, I remember. All right, committee, any questions on any of the 5 reports above and beyond what we've already done? Not seeing any at this time. On a report, Representative Connolly, go ahead.
Mr. Chairman, it's more of a general question about all of the reports.
Sure.
And Mr. Noel, my question is trying to understand a little bit better about the use of these exemptions as they relate to economic development. My guess is that every one of them was put in some way to attract or retain businesses. And so I am curious about, if you know, how other states think about these kinds of exemptions and if they're ever time delimited. You know, for economic development, it would make sense to me, for example, that they last for 3 years or something like that. So I am curious what you know about elsewhere.
Mr. Chairman, Representative Conley, I know that when we originally were reviewing I guess I'd call it the ability of states to attract manufacturing businesses back to the state of Wyoming, one of the things that was looked at was what is the percentage of manufacturing jobs in the state of Wyoming versus what the percentage of jobs in manufacturing are in other states. And I know that we were one of the goals of this was to increase manufacturing as a percentage of the jobs in the state, because they're typically good paying jobs. And I think that's what we were looking at. That's one of the reasons that the report includes the employment data as well, is to kind of get a feel for what manufacturing looks like in the state of Wyoming from all perspectives, including gender specific, number of full-time employees, number of benefited employees. Those are all included in that report. So it does do a pretty good job of kind of getting a feel for where we are from a perspective of is it increasing manufacturing in Wyoming. The other thing is, does it increase as a percentage of our overall gross domestic product? Does manufacturing become a bigger player in that as well? And I think that's something that should be reviewed as well. Is it making inroads in diversifying our economy? Because that's one of the things that I can remember back when this was originally being considered, was that it would further diversify our economy. As it relates to how successful that's been, that's obviously what these reports are for, to try to help in that respect. But I'll certainly, if there's other data that you'd like to see, we can certainly try to add that to the reports.
Okay. All right, committee. I guess we don't have, if there's no further questions on the reports, we can certainly discuss any of the sales tax exemptions. As the members of the House know, I tried to amend the sales tax back on food this last session, and the Facebook comments were not pleasant towards me, to put it mildly. However, I do think that's an area where we could make a significant improvement in our revenue picture. So during this discussion, if anyone did want to make that motion anytime, please do. We do have some people here in the audience who were scheduled to talk about sales tax exemptions, but I'm not sure if any of them want to be proactive if none of them are currently on the table before us. But I am looking just in case. If nobody's making a motion to eliminate a reduction at this time, I probably won't get any public comment. But that being said, committee, we do have what, 100 and Mr. Noble, how many official sales tax exemptions do we have in statute? 115?
No, Mr. Chairman, I believe that there are 54 at last count. And there's a number. One of the things that I hope we can kind of explain is that some of those exemptions are put in place to avoid piling on taxes at each level of production. The ingredient component exemption for manufacturing is one that kind of comes to light. the reason that we allow the purchase of materials that are ultimately going to become part of a finished product, there is no tax paid on those because it's ultimately the tax is paid when that product is sold at retail. So there is a mechanism in place to avoid piling on taxes at each level of production and ensure that it's paid when it's ultimately sold at retail. There are other exemptions that are associated with different entities. Charitable and religious organizations are exempted from taxation. There are healthcare related, and I guess the category is for human services. There are business exemptions as well. And then obviously the ones that you've been looking at are a good share of them are economic incentives, and they're categorized as such. They're in that a number of different categories is how they're listed in the statute. So some of them probably, I don't know that you'd want to change, mainly because they are associated with making sure that the taxes don't apply at each level of production. But beyond that, there's 54 of them that are out there today.
Okay. And from what I remember, the big three are the sales tax exemption on food, data centers, and manufacturing. Is that generally correct?
Mr. Chairman, that is correct. Those are the ones that are directly associated with, I guess one of the things that we really don't know is how much is the exemption for charitable and religious organizations. Exactly what that represents, I do not know because it's never been tracked. I have no idea.
Just guessing none of the committee want to start taxing churches today.
I don't think so.
Never know. All right. Well, committee, if there's any of the exemptions you want to review, I know the Revenue Committee about 12 years ago went through every one in detail. And so I'm certainly not proposing that, but as part of the ongoing search for revenue and not trying to raise taxes, certainly appropriate for the committee to review what our exemptions are. And if anyone wanted to discuss eliminating one of those exemptions, you'd certainly be welcome to do so at this time. Senator Case.
Thank you, Mr. Chairman. I'd also like to point out that I think just in regards to giving notice and being transparent with the public, probably the way we would do it is if it's really a request for a bill draft. So it would be a vote of the committee, but I don't think we should have a final vote on anything along these lines today. That's just my thinking. But, saying we're going to talk about exemptions and then actually voting on a bill to say, put it back on food would be a pretty big radical step. But I would love to see a bill draft that would maybe go after the big three. It looks to me like the big three are pretty suitable for this committee to tackle.
If you want to make a motion, Senator Case.
I will.
Okay. And you refine it for me? I don't want to put words in your mouth.
I would like a bill draft, and maybe it's 3 separate bill drafts, but one would be to restore these sales tax on food, and the other one would be the manufacturing, and I'm drawing a blank real quick on the third
Data
one.
centers.
Data centers, yes.
Okay. Is there a second? Seconded by Baldwin. And so I guess Josh, while you're on, Senator Case would be correct. It would probably need to be 3 different bills.
Probably either way.
That's up to you, Mr. Chairman, and the committee, if you want to see these as 3 or as 1 bill. I think they would fit into 1 bill in a single subject, but up to you.
Mr. I would refine that to say 1 bill, just we don't want to do this 3 times on the pane. So 1 time on the pane for the discussion and going forward, just 1 bill.
Okay. So the motion on the table is just to have a bill draft with all 3 of those exemptions removed, which I'm assuming is a pretty easy statutory repealer for at least LSO's workload to have a bill draft presented and to find the number. I would assume, Mr. Tempe, I know you're on the fiscal work revolving what the numbers would reflect if those exemptions were removed. We could find that data for the committee in 3 weeks if needed. Perhaps Dean's still on, perhaps not. There is.
Mr. Chairman, yes, that would be possible.
All right, committee, any discussion on drafting some bills? Representative Connolly, go ahead.
Yeah, thank you, Mr. Chairman. Mr. Chairman, could you remind me, or maybe LSO staff, didn't we address this exemption issue in a previous meeting, and that we actually kind of took a vote and we did not include food for consideration? And that might have been for the kind of information that we would be getting today. So I thought we had already addressed this issue, and we decided that we weren't going down the road of including taking the food exemption away.
Mr. Anderson, if you remember.
Mr. Chairman, I believe that was part of a larger bill that didn't move forward, that was imposing a sales tax on services as well as removing some exemptions. So I think it was part of a larger package of a bill that we did have that discussion. But if I recall correctly, I don't believe that bill ended up moving forward in totality.
Mr. Chairman.
Sir, Senator Case.
I think that's correct. And certainly you could do the same thing. Representative Conley right now proposed an amendment to remove the food from the bill. We do have to have public comment too.
So the judgment, Representative Connolly?
Yeah, Mr. Chairman, I would like to propose, I can't vote for it the way it is right now, but I'd be willing to vote for it if we removed food from it. And so I would like, and hopefully it can be friendly, Chairman Case. I know you want all three, but that we do two different bills, one of which I'd vote for and one I wouldn't.
That sounds like a nice, elegant way to work through this. I would suggest we split them.
Sure. So I guess who was the second? Senator Baldwin, is that okay with you if we have two bills, one on food, one on data and manufacturing? I think that is great. With that, let's do some public comment. I don't know if anybody here in the Cheyenne wants to tackle the issue of just getting some simple bills drafted so you can come back and visit us at a future meeting. Well, hi, Ms. Levin. Welcome to Revenue.
Thank you, Mr. Chairman. Jody Levin here today on behalf of the Trona industry. The manufacturing exemption is an exemption that's quite important to the Trona industry. I think as all of you know, and the public may know, Trona is unique to Sweetwater County. So it is the world's largest deposit. There is no deposit that rivals it anywhere in the United States. There are some deposits globally. The industry has been incredibly hard hit because of COVID and closures in other states. At the worst of the pandemic, we saw production down 41%. So it has been significant. Prior to the pandemic, the industry had significant expansion plans in the Trona patch. So announced and planned expansions were upwards of $5 billion. 1,500 construction jobs, and up to 500 new full-time employees. The average salary in the Trona patch is $100,000. So these are incredibly well-paying jobs. If you look at the REMI analysis that the Revenue Committee had from a few years ago, one of the areas where REMI said there would be a net benefit to the state was in sectors that had value add tied to the energy industry, the mining industry, and the utility industry. So this is one area. I know the manufacturing exemption is broad and it's not just on Trona, but with respect to Trona, this is one area where I think the cost of the actual exemption is outweighed by the net benefits, both to employment and then overall taxes. So I would encourage the committee to do everything possible to support the Trona industry so that those expansion plans can continue forward.
Okay, questions for Ms. Levin. Representative Roscoe.
Thank you, Mr. Chairman. Ms. Levin, I was just curious if the Trona industry got any CARES Act funding or federal funding for the corona epidemic. Thank you, Mr. Chairman.
Something if you know.
Yes, Mr. Chairman, Representative Roscoe, the Trona industry was eligible for the mitigation fund that the legislature authorized back in the May special session. 3 of the 4 companies did avail themselves of that. So they received the maximum, 2 of them received the maximum amount of $500,000, and I believe the third was about $380,000. They did not take, many of them were not even eligible for the federal PPP program. And to your questions from yesterday about royalty relief, the royalty relief was made available across all kind of energy and mining sectors. The Trona industry did apply and was denied royalty relief in that regard.
Okay. Further questions from Ms. Levin?
Mr. Chairman.
Senator Case.
Thank you, Mr. Chairman. Ms. Levin, thank you for coming here today, and thanks to your industry. They're really important to Wyoming. But can you definitively say that if we remove this exemption, then our expansion plans won't go forward?
Ms. Levin.
Mr. Chairman, Co-Chairman Case, what I will tell you is that they are looking at those expansion plans and determining whether they can move forward. Now, the companies have different analysis for each of those projects. It's a tough situation in the Trona patch right now. Demand is not coming back at the level that they had hoped. It's coming back, so it's getting better, but a 41% drop in production because of demand, it was unforeseen. Prior to the pandemic, projections for the industry were really robust. Their main competitor, Senator Case, as you well know, is China with a synthetic product, and that product is well subsidized by the Chinese government. So they are losing market share. And so it's harder to justify those expansion projects. They're going to do everything possible to make them happen, but it's a harder analysis than it was.
Mr. Chairman.
Yep, Paul.
Thank you, Ms. Levin. I appreciate that. And I appreciate the struggles of the industry and what they're trying to do. But it seems to me the big driver in whether they're going to expand production or not is really about world demand, how the planet comes out of the COVID crisis, whether we get back to normal, all important things, but not much of that has really to do with the particulars of our tax exemption, in my mind. How many years ago?
Mr. Chairman, Co-Chairman Case, I will tell you that the industry will say every dollar counts. And that is an exemption that is a value add to the state. So Wyoming is notoriously good at exporting raw product. This is one of the few examples we have of a refined product being exported in the state. And so the benefit of that tax exemption is important. And again, because of the analysis that ties to employment and the overall benefit in taxes to the state, I think the exemption is benefited by overall employment and tax increases.
Thank you, Mr. Chairman. Thank you, Ms. Levin. Nice job.
Thank you, Mr. Chairman.
And anyone else from the committee? Seeing none. Thank you very much for being here, Ms.
Thank you.
Other public comment, Mr. McLaurin, and then we'll just keep them coming after that. Welcome back to another day of revenue.
Groundhog Day. Bob McLaurin with WHAM would just encourage you to broaden the tax base. This is obviously not a new tax. We understand it has impacts, but just would encourage you to try to do what you could to not add a new tax, but broaden the existing tax base. Yes,
So in general support for both bills then?
Yes, sir.
Okay. Thank you very much. Sir, come on down.
Morning. I think it's still morning anyway. Sir, Case,
Chairman Wanitzer, and members of the committee. My name is Jeff McSchooler, and I'm actually the Executive Vice President of Wireless Operations and Engineering for DISH. I was the first employee hired in Wyoming, just to give you a little history. I was here when we broke ground, built the facilities that you see as you drive by every day, built them up to what they are, and I've had the pleasure of working with Wyoming for 26 years. So anyway, I'm here on behalf of DISH, right? And we have subscribers in the state. Nearly 44% of all of the people in the state of Wyoming are on satellite. So that's huge for us. As DISH Network, we have to provide that. We have to keep that service running. Those people have no other opportunity to get their news, to get their weather, to get their sources. So we're very critical to make sure we provide for them in this state. We're also very proud to be a major high-tech employer in the state. We've located our digital broadcast center, which is 155,000, just over that square feet, state-of-the-art center that houses all of our digital processing center and all the work that we do for our video. That technology generates all video signals for the entire US so that you guys understand the importance of it. And on top of that, we built a data center here in Cheyenne. Those together employ 337 good paying jobs in Wyoming. They get better because as technology is evolving, it's actually leaning more towards data center centric equipment. So technology, we have to train people, get them up to a better speed, teach them more to move forward, and we continue to make that happen. And for any of you that haven't had the pleasure to visit our center, please reach out and we'll be happy to take you out there and tour you through it. I think it'd be great for you to see. One thing people don't realize, we actually have NASA trained folks that are having to transmit signals back and forth to all of our spacecraft in outer space. That happens from Wyoming as well. And we do that for ourselves. We do that for Hughes. We do that for a few other companies. Now, my testimony today is really focused on the proposal to remove the sales tax and the tax exemption, or the sales and use tax exemption for purchase and rental of the qualifying computer software, equipment, power supplies, cooling, as Chairman Case had said earlier, and anything necessary to operate that data center. The legislator passed 2 bills in the past, right, that provided data center sales tax exemption framework, making Wyoming, and I think this question was asked earlier, one of 30 states that actually offer that kind of a tax incentive, specifically targeted to attracting and retaining data centers in their respective states. Meanwhile, 5 other states actually don't impose a sales tax at all. So there is a little different out there. We're particularly supportive of the Wyoming framework because we felt that as a data center operator, it actually required, heavy capital investment and required you to actually create jobs in the state rather than just show up, put in a data center, make it lights out and not actually employ anybody. As I mentioned earlier, DISH owns and operates a growing data facility in our data broadcast center. The broadcast center's first building was completed in 1995. That's the one that I moved here for in 1994 and I built, followed by our second building in 1998, which was to accommodate growing for our DBS business. And in 2006, we actually had to build a third building to accommodate the number of people we had and continue to grow. And then and it also had power and power generation in it. And in 2011, we built the data center that we have out there on Camp Stool Road today. And we continue to operate that. Thanks to the incentives provided by this legislature, we were able to not only sustain, but grow our operations and increase our number of high-paying tech jobs here in Cheyenne. And I'll talk a little bit more about that in a minute. But notwithstanding the incentives, we pay nearly $500,000 each year in just sales tax alone on non-qualifying software, equipment, and cabling for our broadcast centers. That's all, of course, in addition to our property tax, payroll tax, and other taxes we pay in connection with operating this facility. Equally important, we made a major capital investment when we agreed to build a data center here in conjunction with the state of over $50 million just to build it. And we put another $70-some million into it since then in hardware and investment. Now I want to be the first to say thank you because you've created an opportunity to bring those high skill paying jobs to Wyoming, and you create an opportunity for DISH to actually make that financially work for us and to be able to continue to grow in this state without having us, to have to offset our costs to someone else or to the customers of Wyoming. But you let us expand our footprint and continue to contribute to be a great employer in this great state. Wyoming's helped us succeed and grow, providing our services to millions of Americans throughout the United States. We'd like to think the state is a partner of our success and therefore collaborate on ways we continue with our success in the state of Wyoming for coming years. We know things are tough in the legislature. You really need to make difficult decisions right now, especially with the impact of COVID-19 has had on all budgets. We see that. But we fear that increasing our tax burden may make it harder for us to do business and will have the opposite effect as it will stifle investment, innovation, and growth, as noted in the Department of Revenue's own report. Specifically, the department requested economic analysis by the Wyoming Business Council to remove the sales tax exemption would unfortunately lead to job losses and a decrease in GDP each year over the course of the next 10 years. Wyoming's data center tax incentive policy Wyoming's data center tax incentive policy and will likely continue to generate high-skilled, high-tech jobs and real estate capital and investments like the one DISH's data center has brought to the state. More than half of the states in our country offer similar incentives such as the one that we're discussing today. They're critical to maintain a competitive edge and attract companies that are considering whether to maintain and build new large square foot data center assets that require both skilled and unskilled workers and make large scale equipment purchases on an annual basis. All of which helps us grow in the local community. Equally important, policies like the sales tax exemption on power supplies, equipment, and software for data centers ensure DISH can continue to invest our 5G deployment plan in Wyoming and underserved areas. A process that required not only an infrastructure build out, but hiring workers to develop and maintain the infrastructure. We respectfully request that the committee recommends keeping the Wyoming business friendly and competitive by sustaining the sales and use exemption for data centers as you consider other fiscal measures in Wyoming ensuing economic recovery from the pandemic. Thank you.
Well, thank you, Mr. McSchooler. And this would be a good time to just let everyone know that DISH is in my district. And yeah, I can see them from my house every morning, which is exciting for me. Questions for Mr. McSchooler from the committee? Not. Representative Larson, go ahead.
Thank you, Mr. Chairman. I just want to thank you for this testimony. It's a big deal keeping these businesses here, and it's so important. I think I'm going to vote no on this. I just want to ask the question, if we had this tax when you thought about coming to Wyoming, would it have been something you had thought about before you came, I'm sure. So thank you again.
Yeah, so in 2011, when we built the data center, before that, myself and Paul Bellotti, who's sitting behind me here, we actually traveled the entire US to look for where to build a data center or to buy one. And as we went through the whole thing and we came back, one of the things that we talked about with the state was, is there any way to give us some help? Because everything that we pointed to said we should build one, not buy one, meaning we should build it from ground up, not go buy and refurbish someplace else in the country. And this did help. It helped make our decision and help push it forward. And so I do appreciate you asking that question. One of the other pieces right now in our 5G deployment that we're getting ready to start. So we're becoming the fourth tier 1 provider in the United States for telecommunications and for mobile service. That requires massive data center backup everywhere that we go, right? And so, and I'm actually up here today because we're doing some testing up here and I wanted to come see you. So I just got to work both out in one, which was fantastic. But with that, we're growing those centers and we've got to decide, right? Do I continue to grow those centers or is it cost effective to move out? And I think the piece that people don't realize is all companies are being driven right now to head towards cloud. Everybody's saying, move your stuff into the public cloud, get it out of your own data center. It's not cost effective, doesn't work, right? And I get driven that way from my chairman. I work directly for the chairman. And I go back every time and say, yeah, that's true, only if, right? And there's pieces to it that make sense, but there's a lot of pieces that don't. And right now we're trying to lay out, do we grow that stuff in Wyoming? Do we grow that stuff in the public cloud? How much goes where, how much doesn't? Do we put it somewhere else? Because we have other data centers in the country too. This just happens to be the big bad mama that we built on purpose because this is where we wanted it to be. So that's one of the things that I always have to take into account as I'm looking at what we're going to do for our future. But that's one of the worries that I think everyone needs to understand is that cloud, could pull this from us if we're not all careful, right? And so we don't want that to happen either.
Any other questions from the committee? All right, well, thank you very much, Mr. McSchooler, for coming before us today and for the continued opportunities you're giving my community in Cheyenne, which benefit the state of Wyoming and people all over our country and world. Right here in Wyoming. Good success story.
Thank you so much.
Anyone else public comment? Mr. Bush, welcome in person.
Mr. Chairman, members of the committee, thank you. Happy to be back in the Capitol in person. David Bush, representing Black Hills Energy. As Co-Chairman Case pointed out earlier, we're the local utility here in Cheyenne, serving a couple of these data centers. Won't take a lot of time, just echo what's been said about the importance of the exemptions and bringing the data centers to the state and specifically to Cheyenne, and our role in that and providing that power, making sure that the data is got that good power that comes from Wyoming. The conversations that we are engaged in as the utility and the power provider, it's pretty clear from the folks that are looking at bringing data centers here, if you want to call them like a third-party recruiter, they don't consider states that don't have any sort of incentives. There are so many, as you just heard, a lot of states, it's a very competitive market to try to get these data centers here. So in order for us to be a player in this space and continue to grow the technology sector and really the economic development that comes with it for the state, it's important and critical to have these exemptions for the data centers. So I don't have a whole lot of specifics. There's a lot of stuff that is proprietary and can't really go into it, but just say the information that you have is a part of the picture, the economic impact to Cheyenne and Laramie County and certainly other parts of the state where these data centers could be located. And it goes beyond weather and geography. We've got, as Senator Case pointed out, we've got a aggressive way that we can work with them on price with our product on the electricity side. And they're looking for opportunities. We've got land. It all makes sense. But in order to continue to be a player in this market and to continue to get these companies to look at Wyoming and even consider us, we've got to have these exemptions as part of that.
Okay. Questions for Mr. Bush, Black Hills Energy? Representative Sweeney.
Thank you, Mr. Chairman. So, Mr. Bush, did you look at the actual report?
The report you're referencing from Mr. Noble on the sales tax exemption, Representative Sweeney?
Yes.
Sure, Mr. Bush.
Mr. Chairman, Representative Sweeney, I did, yes.
Oh, thank you. With that, did you find in there the consumer actually does pay a sales tax on that electricity generation that's not exempt? Am I correct in that understanding?
Mr. Chairman, yes.
Correct. Third one, Representative Sweeney?
Well, and I just want to point that out that there is that they're not exempt from everything with this, and as they use the electricity, which they use large amounts, they are paying sales tax on that amount, as well as other taxes on services that they're taking in. And I just wanted to clarify that it's certainly not a free walk for these industries. So thank you, Mr. Chairman.
Mr. Bush, would you generally agree with that sentiment?
Yes, and if I, Mr. Chairman, and I apologize if I made it sound like they were not paying anything, then I apologize for that. That wasn't what I was trying to convey, so.
I think you're good. And you could, if we took out these exemptions, you may pass that cost on to the consumer. You may be forced to in some cases.
Larger conversation to be had there, Mr. Chairman. But, Mr. Chairman, one other point is, again, another sort of ancillary impact is we're building a wind farm west of Cheyenne here. Corriedale is the name of the project. Some of that is going to South Dakota, some of it is staying here in Wyoming, and that is to provide power to some of these data centers that are looking for alternative sources, renewable energy, things like that. So I'm imagining, again, I'm not in these meetings in Rapid City, but I'm guessing that we're going to be looking at probably some more renewable projects down the road, which again, more development, more taxes, more development for Laramie County and the state in general. So.
And quality jobs.
Yes, sir.
Good stuff. All right, further questions, Mr. Bush? Seeing none at this time, thank you very much for coming all the way down here.
Well, it was a far drive, Mr. Chairman, let me tell you. Thank you, sir.
Next up, Mr. Bunker with the Wyoming Food Coalition. Welcome to the Revenue Committee.
Thank you, Mr. Chairman. It's a pleasure to be here. My name is Adam Bunker. I'm the president of the Wyoming Food Coalition, and I'm also the operations manager for Papa Joe's Produce, which is a family-owned leafy green producer in Sheridan. I'm here today to ask that you not reimpose the grocery tax, or I guess more specifically, remove that exemption, or at the very least to consider including a continued exemption on grocery staples. So in 2018, Wyoming households spent almost $1.9 billion on groceries. So it's a pretty big number, and obviously most of that food did not come from Wyoming, or much of it didn't. So most of that money simply left the state, other than what was retained by the stores. I can see where that would be an attractive opportunity to address some of the budget concerns that we are facing as a state. However, having worked with sales tax before and understanding what that process looks like, I think that would strongly discourage many of the other small and medium local producers who I get to see every week through our markets. These are folks who are growing things or making things as a side business to supplement their income. For some of them, it's something they may want to pursue in a bigger capacity at a later date, but right now they're just trying to get their feet wet. And if they had to go through the bureaucracy of sales tax, I think it would discourage many of them. Furthermore, I believe it would potentially stifle some of the innovation that we've seen in this sector over the last year. In March, when things really started to get pretty heated up, our business partnered with a dozen other local producers to launch a virtual farmers market where customers could buy our products online. We would deliver it to them once a week. And in the first 2 months of that, we had more than $12,000 in sales of local foods. So that's $12,000 that didn't go to Amazon, that didn't go to Walmart. It stayed right here with us in our community. And then we in turn spent it on other local products. So it's one of those things where in business, a solid perspective is it's easier to keep the dollar you have than to bring in a new dollar. And that's what we work to do, is support local foods so we keep more of that grocery revenue here in the state. Furthermore, from the Food Coalition standpoint, grocery taxes tend to be more of a regressive tax. They disproportionately affect folks who are maybe down on their luck. $30 a month in taxes on your groceries is much different for someone who's making $20,000 a year or who just lost their job than it is for someone who's making $80,000 a year. So that's another thing we would ask you to keep in mind. Now, I mentioned potentially an exemption on staple foods. So that would be, we understand you're balancing a lot of very serious considerations here. And so if there was just no way around this, we would ask that you consider leaving the exemption in place on staple foods. Maine, for example, does this, where they exempt grocery staples, which are food products ordinarily consumed for human nourishment. They do tax things like alcohol, chips, soda, granola bars, things like that are maybe not quite a staple food. And so if, based on the numbers we've looked at as the coalition, if Wyoming were to adopt a similar policy, that would still generate another $31 million in revenue, but that kind of an exemption would likely not apply to most of the local producers and to the staple foods that people really need to buy. So for those reasons, I would ask that you consider either not removing that exemption or considering some kind of language that would not hamper our Wyoming grown food economy. Thank you very much.
Appreciate that, Mr. Bunker. Questions for Mr. Bunker? And he did reference states like Maine and other states that literally differentiate product by product on what's taxed and what's not. And It's not an all or nothing approach when it comes to putting a sales tax back on food products and things like farmers market or things that could be grown and made in Wyoming. I think that's a great avenue for me personally. I think it's a great avenue to explore because you're correct on large corporate grocery stores versus stuff homemade and smaller mom and pop operations here. We could bifurcate it in some way, shape, or form.
Mr. Chairman.
Senator Case.
Mr. Chairman, I'm intrigued by that as well. I don't think you can bifurcate it by who's selling it, but I think it's the product as Mr. Bunker talked about, and I'd like to hear more about what they do. It does sound a bit complicated though, and I think that would be the problem with administration. And there's some value judgments in there too. I might be very fond of the nutritional value of potato chips, for example, but maybe others would disagree, and whether it's taxed or not. That's just a good example. I'd love to hear Mr. Bunker's thoughts a little bit farther. He sounds like he knows more about how they actually do it. Appreciate that.
And I don't know, Mr. Bunker, if you want to respond to that now, or if this bill draft moves forward, just joining us in December. But if you did have additional thoughts, I'm certainly happy to have you extrapolate on what might be possible this time shortly.
Thank you, Mr. Chairman. I would appreciate a chance to maybe dig into a little bit more on specifically how some of those other states have done that. And the Food Coalition would be more than happy to provide some further input on that as this goes forward.
Great idea.
Other questions from the committee for Mr. Bunker? Representative Roscoe, is that a question?
Yes, thank you, Mr. Chairman. Mr. Bunker, maybe I have heard that certain states, just for the disadvantaged, where there's a chip program and certain foods are allowed on that chip and certain ones aren't. And so it makes it really, really simple to track all that. And so it takes care of the disadvantaged people without a whole lot of hassle, so to speak. If you've heard of anything like that, let me know. Thank you, Mr. Chairman.
Mr. Bunker, if you know of any top of your head, but we certainly have programs in Wyoming as well in our social safety net for providing tax-free opportunities for food through WIC and various other programs. So if the tax did go back on certain food products, I'm sure we would differentiate that as well. But Mr. Bunker, if you know of other examples, feel free to jump in.
Thank you. I think that's something we've looked at that with our local farmers markets, and this is maybe a side note, so I'm sorry I won't go too long into this, but as a quick answer, we can take some of those programs, SNAP, WIC, things like that. Legally, we can. That's an issue that we're working through at the Food Coalition. One of the problems we run into is just implementation because of the guidelines in place of who has to actually be there at the market to administer those programs. We have a hard time doing that, even though we technically can. So that's a great idea in terms of how can we continue to expand that. And it does certainly fit into this conversation. But that's kind of where things stand right now, is that's just hard to implement in terms of buying local foods.
All right, further questions? Seeing none at this time. Thank you very much, Mr. Bunker. Any further public comment from the audience? I'm not seeing anyone jump up here. So with that committee, we have a motion. I guess we have two separate bills as part of the motion, so maybe we should differentiate them. So the first motion would be for this committee to look at a bill that would remove the exemption on manufacturing and data centers would be up first. And so I believe, did you get a second on that motion? You did.
I got a second on both.
Okay.
I believe it was Paul.
So we'll do them as two separate motions. The first motion on the floor is for the data and manufacturing tax exemption to have a bill to look at our next meeting to remove those. Is there further discussion from the committee regarding those two exemptions? Senator Ellis.
Thank you, Mr. Chairman. I just want to let the committee know I'll vote as a conflict on this measure. In disclosure, my husband works for a company that has a large data center in Cheyenne. Although I don't have an actual conflict, I do want to be sensitive to the appearance of a conflict. And so for that reason, I'll be voting as a conflict.
Okay, now let me just double check, Senator Ellis. Would it make a difference if I divide it into 3 bills for a data center and a manufacturing?
Mr. Chairman, likely no. If you divided, the food is a separate issue, but I'm guessing my law firm might have clients that will weigh in on the manufacturing exemption. And so again, no actual conflict, but want to avoid the appearance of one, so would vote either no or conflict on that as well.
Okay, appreciate that. Representative Hallernan.
Thank you, Mr. Chairman. I have a comment about the manufacturing exemption. The cost to the state is $13.8 million, and the amount of increase in the GDP is $11.2 million a year. And the average cost for the 75 employees that are reliant on this exemption is $180,000. I think that is a reasonable cost for such a exemption. The lady from that presented on this issue said that the average wage of these employees is about $100,000. So I think that the state's cost of $180,000, considering the extra costs that are associated with an employee also, I think is reasonable. Therefore, I would oppose that exemption, or I would be in favor of the exemption and opposed to the bill. For that reason, I would vote no on that item. Thank you, Mr. Chairman.
Okay, further discussion. Senator Case.
Mr. Chairman, I would respond to the good doctor by saying it's a correlation, it's not causality. We eliminate the exemptions. Will we eliminate that economic activity? No. Will we eliminate some of it? Possibly. And so to do the analysis and pretend like, I didn't mean to pretend sound pejorative, but to assume that if we cut the exemption, we'll cut 100% of the activity, that's just not possibly true. So there'll be some amount cut, something less. I think that's a pretty expensive deal, actually. That much money for 11 million in state product, and those jobs, those are pretty expensive jobs at 180,000 a piece. So I just push back, and I respect my good colleague.
Okay, further discussion from the committee. All right, so the motion, well, it's just a hand vote only. All of those of you who wish to see a bill draft to eliminate the exemptions on manufacturing and data centers at our next meeting, please raise your hand. 1, I got Case, Selman, Baldwin, Roscoe, and Connolly. Okay, all those opposed? I got Larson, Sweeney, Blackburn, Hallinan, Western, Beitman, Driscoll. Swanson. Okay, that motion does not pass. Second motion on the table is to bring a bill to remove the tax exemption on food to our next committee meeting. And I would pledge to the committee to further dig into possible ways to kind of bifurcate or segregate what taxation would go back and what wouldn't, in line with Mr. Bunker's thoughts if this motion passes. Any further discussion on that motion? Representative Connolly.
Yeah, thank you, Mr. Chairman. I'll vote no on this one. And I pulled up the spreadsheet that Mr. Noble provided earlier today. And I just looked at those bands of income. If you remember, he told us that we have 278,000 taxpayers in the state. When you look at that band of under 25,000, that very first one, it's 93,000 of the 278 earn under $25,000 a year. Those are the people that would be impacted the most by putting the tax back on food. And so I will vote no. That's a third of our taxpayers.
Thank you, Representative Connolly. I would slightly push back that if we don't raise some revenue, those might be the same demographic of people who are losing their jobs and leaving the state. So Dinged if you do, dinged if you don't. And I think that's what we're facing right now. So, Senator Case.
Mr. Chairman, I understand the regressive nature of taxes, especially excise taxes. I understand, especially on food. All I can point to is that we have a very unbalanced tax structure in Wyoming, and that we need to look at the totality of the taxes that people pay. And I think if you compare each and every tax and call it regressive and fight to the death on that, we need to understand that if we took these same people and the same amount of taxes that they're paying in Wyoming and place them in any other state, buying the same commodities, living in similar houses, and the totality of the taxes they pay, everybody gets a good deal in Wyoming, including these citizens. And finally, I just note for the safety net, there is a safety net. It may not be as good as it should be, that provides food and other, tax-free for our very poor. At least I hope it's working as well as I want it to play. So the reason I support this is it kind of nudges us in a broader direction. And we're all subsidized by the taxes that are paid by our big mineral taxpayers. And every one of us pays less, than we would in any other state. Any other state. I'll leave it at that.
Okay, further discussion, committee. Seeing no further discussion, the motion is please raise your hand if you would like to see a bill at our next meeting eliminating or modifying the sales tax exemption on food. Please raise your hand. I got Case, Selman, Blackburn, Baldwin, Sweeney. Okay, all those opposed, please raise your hand. I got Larson, Hallinan, Western, Beitman, Connolly, Ellis, and Driscoll. So that would be 7 against. And I'm not sure I got your vote, Representative Roscoe, either way, but 7 no votes, that motion will fail. And 75 million of revenue to the state as well. So with that, committee, I don't see any further business this morning. We'll go to lunch, come back. Do you want to do 1:45?
I think 1:45 would be more realistic. I honestly believe that the discussion this afternoon won't take as long a time as we've blocked it out. We'll get to the bottom of this pretty fast. So remain heartened and we'll see you at 1:45.
Okay. Enjoy your lunch till 1:45. Reminder, take off your video and your microphone. And if you're on YouTube, remember there will be a different link this afternoon for the afternoon YouTube.